Биткоин кто может запретить? Никто.
The game theory has changed around this for national political stability, for bringing back the middle and working class, for defense-based reestablishment. All of these things are pointing to a neutral reserve asset. And then you go, okay, well, it's gold or it's Bitcoin.
Losses in Afghanistan, losses in Ukraine. We're going to see a pullback of imperialism.
It's realism.
The United States is currently over $36 trillion in debt. Where does that go and how does that end?
How can I afford to buy any of this stuff coming off the line? I'm broke. You stole all my money.
So this is an existential issue for the country, basically.
Yes.
Like, you can't impoverish people. You have to produce stuff. You have to be ready to defend.
Inflate or default?
Yeah.
The game theory's turned on its head. Holy cow. Bitcoin isn't a threat that it's rising. It needs to go up faster.
Also, wouldn't like to go down this too far, but I couldn't help but feel the... Thank you for coming to Miami. Tell me, is it a fund that's Forest for the Trees, or is it a research?
It's research. It's a research firm.
Research firm, strictly.
Forest for the Trees. FFTT.
Forest for the Trees.
Yep.
I always love the name of it though, because it has to do with like emergent properties. You know, people talk about, well, where do the trees end and the forest begin, kind of thing.
Yep.
So I always really liked the name of your research firm.
Thank you.
And then also really liked your work.
Thank you.
You're a very notable guy with opinions on all things geopolitical, strategic, technological. I mean, your thinking really spans a lot of gaps, and I think a lot of people really appreciate the insights you bring to the table. And it's been great, I think, to see you come around to the Bitcoin side over the past few years.
Kicking and screaming, right? Or
you were always trying to recruit the best and brightest, and I think a lot of people were rooting for Luke to join Team Bitcoin. Maybe we just start obviously you've been on the show before. The first time we've met in person. Can we just do a little background on you?
Sure.
Who are you? Where do you come from? How did you get into this business?
Sure.
How did you develop the mind that you have today?
I don't know how I developed the mind. It's kind of always worked this way, which is to say, it's interesting. I saw somebody recently give an interview where they talked about being left-eyed and right-handed when they shoot, and that there was some sort of way their brain worked that was different than a lot of other people, which made me wonder, I throw left-handed, I write right-handed, I kick left-footed, I shoot basketball righty, I bat righty, I golf righty. So maybe there's the way my mind works differently or connects dots, the way it connects it has, maybe that's a symptom, maybe it's a cause, I don't know, but maybe I'm using different sides of my brain differently than some other people. I don't know, but it's kind of just always been that way for me. In terms of my background, I grew up in Cleveland, Ohio, outside of Cleveland, Ohio. Sort of a classic middle-class American upbringing. Dad was an accountant. He's retired now. My mom was a speech pathologist. She's retired now. I'm the oldest of 4 kids. Played sports, went to school. When I got to the end of my high school, I decided I wanted to be an architect, is what I thought I wanted to do. And so I applied to and got into the University of Cincinnati's Design, Architecture, Art, and Planning School, which was I think still is, one of the top 5 architecture schools in the country. So pretty much a layup. You get in the top 5 school, you go. Spent about a quarter and a half doing architecture, realized I hated it. I did not want to be an architect for the rest of my life. But I was spending a lot of the time asking, during design classes and what have you, projects, who's going to pay for this? Who's going to finance this? And these types of questions. So I switched to finance and accounting and got my degree in that at the University of Cincinnati. Cincinnati has a co-op program where you go to school a quarter and work a quarter throughout your career. And so I went to my first summer co-op. You work with an advisor, they find you a spot. I'd love to say there was some grand design, but it was my now wife, then girlfriend, was in Cleveland for the summers. And so I wanted to be in Cleveland for the summers rather than Cincinnati. So I started working as a research intern at an old line Cleveland money management firm named Ralston & Company that had a small sell-side research business attached to it. Worked there summer of 95, winter of 95 into winter 96, went back for my second co-op term, and the business was splitting up. The Ralston family was looking to exit the research business to focus on money management. I decided to go with the 8 partners that launched a firm that was called Midwest Research out of that, and I was probably employee 10 or 11, 8 partners and a couple other folks, and then me literally sitting on the floor of temporary office space, licking envelopes, running to the store with a partner's credit card to buy a printer, whatever, just I was the gopher. Mm-hmm. And came back summer of 96, started working in research, spring of 97, winter 97. They made me an offer to work with them as a junior salesperson, just doing prospecting, et cetera, for institutional equity sales, and was hired on full time when I graduated, and worked my way up there. Was given an equity stake in the business relatively early on, based on performance, and the senior partner sold that business to First Tennessee out of Memphis, Tennessee.
Okay, First Tennessee
in early 01. Mm-hmm. And then I was an employee of First Tennessee Bank. And again, reprising my role, institutional equity research. Along that path, I started doing with another gentleman something at Midwest called Heard in the Midwest, which was a Friday piece. I was a real junkie for the research. I love to read. I love to, my brain just, its own, I joke with my wife, my brain's like the flower in Little Shop of Horrors, which is feed me, Seymour, feed me. Like it just more. So we were very early pioneers at Midwest Research in the primary research trend. When I came up in the business in 95, 96, the way investment research worked was the analysts covered 10, 15 companies. They picked up the phone. They called the IR guy or the CFO or maybe the CEO, asked him how the quarter was going, and got that information, wrote it up, gave it to the sales guys. Sales guys picked up the phone, called institutional portfolio managers and analysts on the buy side. That works great in 95, 96, 97 when you're in a raging bull market. We covered a lot of industrial stocks, though. And in the fall of 97, there was a lot of, the Asian crisis started to happen. Mm-hmm. And so by spring of 98, the U.S. industrial sector was firmly going into recession. So while the stock market was still booming, the U.S. industrial sector was in a full-on recession. And what we found was that when things are good and you call the CFO and ask him how the quarter's going, he tells you it's good. And when things are going bad and you call the CFO and ask him how it's going, they still tell you it's going good. Partly because of human nature, partly because the SEC doesn't like CFOs giving out, hey, we're going to miss the quarter unevenly. Right. There's securities laws that have to be respected. And so we ended up having buy recommendations in the late 90s on 2 of the worst performing stocks in the S&P 2 years running. Mm-hmm. And what we decided as a firm to do, there was a couple research and sales guys in particular were real leaders in driving this process, was we need to start we need to start doing primary research. Mm-hmm. We need to start calling distributors. We need to start and building a mosaic. Mm-hmm. And we started doing that. We built that business up, and we're real early pioneers in it. And I was a junkie for reading not just the notes, the research notes of the finished product. Hey, here we did a bunch of calls, or we talked to the CFO, and here's what we think. But the raw data, I want to see what they were actually saying. Mm-hmm. And I would read through this stuff. And myself and another gentleman, a longtime mentor of mine on the sales desk, we started doing this Heard in the Midwest piece, where we would pull together just pieces of data that were interesting. And I didn't know what I was looking for. Mm-hmm. It was just one of these things where I would see it, I would read it, and it would trigger like a
pattern recognition.
Yeah, it would trigger a splinter in my mind. And I happen to be very good at dot connecting. So I would, hey, we're seeing this. And it was basically ended up being a bottoms up research macro piece. Whereas a lot of times in macro, you start from the top and work your way down. This was, hey, we're talking to 200 data points every week, and we're seeing this many raising prices in these industries and this many cutting prices in this industries. And these distributors are losing share to China and all these different things. And it ended up being a very, very well-read product across Wall Street, not just the clients I was calling on for the firm, but across the sales department. Research was sending it was sending out as well. And so that was probably the predecessor to what I do now, which was this ability to loving to read, able to read and retain a lot for whatever reason, and then being able to connect the dots in a way that is relevant and useful, and more often than not predictive. I was able to, a lot of times, the reason people love that piece is we were seeing things before they happened. Like myself and about 20 other partners left Midwest Research in the summer of 2006 and started Cleveland Research Company, doing the same thing, was reprising the same role with this Friday summary piece. And our firm's research was extraordinarily helpful in helping clients position ahead of what happened in 2007 and 2008. And after 2008 happened, what I started to find as I was connecting the dots was the correlations inverted. In other words, pre-2008, when the Fed first did the first big intervention, our research with, hey, we're seeing things slow down. Okay, you want to be short stocks, long 10-year treasury, because yields are going to go down on the expectation of softer growth. Very sort of right down the middle of the plate, market reactions. Post 2008, it flip-flopped. Our research would show things were slowing, and the stock market would take off, and yields would rise. And it was the market had already become conditioned to the monetary heroin, to the QE. The market was already starting to say, the economy's slowing. I don't want to sell stocks, I want to buy stocks because it's slowing, and that's just a matter of time until they have to print more money, until they have to renew QE. And bonds wouldn't be bid, they'd be sold, because bonds would say, oh, here comes more money printing. Why do I want to own bonds? So it was one of these early stage that gives you some sense of, I guess, how I got to the lead up to FFTT. And after a few years at CRC, Cleveland Research Company, still a lot of great friends there. Decided I wanted to do macro full time, but we were still really known as a bottoms up fundamental shop, and so decided to part ways amicably. I hung out my own shingle as FFTT, and I connect dots. I read voraciously all day, every day, and I don't know what I'm looking for. I don't start with a thesis. I have some idea of what I think is happening. Sure. And then I'm looking for outliers, right? Here's what I think is happening. And the things I think that most grab me are the outliers in both directions, in terms of, wow, it's happening faster than I thought, or wow, this is what I thought was happening, but this series of data points completely nullifies how I was thinking about the world. I've got to go back and revisit, and then turning that into investable sector or thematic work for my clients.
So you too get to nerd out for a living.
It is really a dream job. It's funny. I couldn't imagine doing anything else. I am very, very fortunate.
That's so cool. One of the things you said there reminded me of a prior guest had described markets as a psychological engine. And you were saying that there was a time where, I guess, your bottoms up view on market reality indicated one thing, but there was some, I guess, tipping point where market psychology actually shifted to expect the next hit of the monetary heroin or the money printing or the quantitative easing, whatever we want to call it. Can you maybe describe, I'm just curious how market psychology maybe is supposed to work, or how markets are supposed to function properly as psychological engines, kind of matching people's expectations or visions to actual supplies of capital in the world, and what money printing does to distort that process.
I think ultimately prices are just information, right? So if we start from a first principle of prices are information, then we can work backward from there, which is information is just information. Some information is politically inconvenient for certain people and needs to be managed. And a way to manage prices is by distorting them.
Price signals, yeah.
By distorting price signals. And the way you distort price signals is price controls or one way or another. And there's different ways you can do that. You can put in yield. Ultimately, they usually have a center around some form of increased currency unit creation to do that. And I think that is when you start and work back from that first principle, then once you can do that in the shadows for a while, and that's fine. You can do it around the edges and around the margins. However, if you do it too big and you do it too obvious, then you run the risk of basically poisoning the psychology, of shifting the psychology in a permanent way. Also, if you demonstrate the measurables, right? Or you demonstrate the Pavlovian bells that you respond to, the signals that you try to cap, then you start to see the markets, who are very smart and very forward-looking, watch those Pavlovian bells and the things that might make them ring, because then they will be able to say, I don't have to wait till that bell rings. I know you're not going to let it ring. And I know this, it's like a Rube Goldberg trap, right? Where, okay, if that bell rings, you're going to add liquidity, and this lever is feeling pressure and it's coming towards, and it's going to hit where it is. And I'm watching that lever, because as soon as it gets near that bell, maybe I'll get the timing a little off, but I'm not going to be wrong. That's just a positioning, right? So the markets will start watching that, and I think that's what we started to see, which was all the way back in 08, 09. Oh gosh, fundamentals are slowing. We know the banking system isn't going to be allowed to fail now. That was the big thing.
Right. Too big to fail.
So if the banking system isn't going to be allowed to fail, and this data is showing us we're heading back into recession, as was absolutely happening as you moved through certainly late 09 and into early to mid 2010, markets started discounting that the big political thing, okay, the banks won't be allowed to fail, then recession will not be allowed to happen. And if recession cannot happen, or else the banks will fail, then it won't be allowed to happen. And buy stocks on a coming recession. And and the problem then is, once you do that once, you haven't fixed the underlying problem.
Right.
And so now it's not like the debt has gone down. The issues that caused the original problem, they've been moved, right?
They've been worsened, haven't they? Because now, aren't you now incentivizing people to invest more in the financial sector because it's not going to be allowed to fail? So moving capital out of the real economy into the financial sector, which accelerates or exacerbates the process of financialization, something like that?
Yeah, it's right. So we started with the problems. We did .com. We didn't bubble burst. We didn't want to deal with it. So we kicked it upstairs to the housing market. We built a housing bubble. It burst. We didn't want to deal with it properly. So we kicked it upstairs to the sovereign level. Now the sovereign bubble is fine. It's not a problem until you have inflation. Once you have inflation and a sovereign debt bubble, you're done. And that gets to your point of, yes, it makes it worse, because now people are moving into financial assets rather than productively allocating capital. So now you're, at least 15, 16 years into a gross misallocation of productive capital. And that misallocation of resources showed up in COVID. What do we hear all the time? Well, it wasn't that we printed all the money. It was just supply chain problems. What's a supply chain problem? A supply chain problem is nothing other than the Pavlovian bell of 16 years of misallocation of capital into, monkey JPEGs and stuff instead of investing in supply chains.
Yeah.
And so now you get into the spot where the debt's gotten higher. It's still a sovereign debt bubble. You now have endemic inflation. And now you want to invest in supply chains, which is, I think, going to happen. I think needs to happen. It's a good thing.
Right.
It's not going to be deflationary.
Right.
So guess what? You're going to have to do the mother of all. Price signal, muffles, right? You're going to have to strangle the $130 trillion bond market in the crib. You're going to have to put a pillow over its head and hold it down until it stays at 4% on the 10-year. And whether inflation is 10 or 20, doesn't matter. You're going to have to. Or you can't reshore. To your point, it's like any great, it's like the Madoff Ponzi scheme, right? Like the little lie becomes the bigger lie.
Right.
There's Enron, the little lie, the bigger, big. And sooner or later it gets so big, you can't hide it. And now we're at a point where the price signal that needs to be distorted is the price of money, but it needs to be distorted like in a $130 trillion market.
Right.
That's not going to be 5 or 6% CPI. Right. That's not how that works. We're talking about double-digit levels of inflation, and arguably we might have already had that, right? To the point of the whole. Larry Summers said, "Hey, if we calculated inflation the way we did pre-'83, it peaked at 18%." This is Larry Summers, who's a very good academic. Say what you will of himself. He's not my guy. He's not my kind of guy. I don't particularly care for him that much, but he's very bright and he's a very good academic. And inflation might have already been double digits, and it wasn't enough. It was not enough to get the debt down. It was not enough to reshore and rebuild anything. We didn't do anything. We just handed stuff out.
So it's kind of like the buck stops at the sovereign debt level, right?
At the sovereign debt or the currency. Ultimately, it manifests in the currency.
Yeah, because the sovereign debt basically is paid through the money printing ultimately, right?
Yeah.
So maybe let's talk about that then. The United States is currently over $36 trillion in debt. That has grown significantly. I'll let you tell me exactly how fast, but I want to say it's roughly doubled in the past 10 to 15 years. Estimates say that's the official number. There's also estimates of $220 trillion in unfunded liabilities. So at that, just the $36 trillion in debt, we're talking about 140% debt to GDP, which typically, historically, as I recall, is like basically unsustainable, right? Like any country that's gone to that level of debt to GDP has ultimately hyperinflated their currency. How did this get so out of hand? And what is this like? This sounds very abstract for a lot of people, and I think part of our job as thinkers in this complex space is to try and demystify it for people. So how can we explain how this got out of hand and what it actually means for people in their day-to-day lives?
So I think the part of it is the nature of the system, right? When you have a debt-based fiat monetary system, the debt, you create debt when you spend to offset the spending. Sort of this modern monetary theory accounting is government accounting. So some of it is just how that works. The other part is the part that is usually not talked about as much, which is we did really dumb things with the money. We made bad choices. In theory, if the government borrows money and invests it wisely in a way, increases in debt, invests wisely in a way that it is economically positive value added, then the debt shouldn't really rise very much, right? You should be earned. There should be a positive rate of return. And so some of it is systemic of how the system is structured, but a lot of it I looked at it the other day. We've increased debt since China entered the WTO in December of 2001. U.S. federal debt's gone up $30 trillion since December of 2001.
Okay,
of that
so
36 trillion.
So 23 years, we've gone from 6 to 36.
Correct.
Staggering.
And we don't have high-speed rail all over this country. We haven't solved the war on drugs. We haven't solved the war on terror. We haven't solved children are not reading at a higher level. They're not healthier. They're sicker. We've not completely paid off Medicare, Medicaid. We have nothing to show for it.
I was going to say, we have nothing.
I mean, our highways have been kept in decent shape, but it's not like, you go around the world, our highways, some are better than others, but we're certainly not the envy of the world, which we ought to be having dropped 30 trillion. So what do we spend it on? Well, 8 trillion of it was in the Middle East, where we spent 20 years taking Afghanistan from the Taliban and then giving it back to them 20 years later. This is the very definition of a complete waste.
Right.
And if that was a business, and I understand that government is different than business, but from a conceptual standpoint, I think it's important to frame it this way. If that was a business, that would be a bad investment, a bad acquisition, and you would write it off. You would take a charge and you would write off the entire $8 trillion. And that's what needs to happen. The backstopping of the banks. Historically, in capitalism, what the U.S. through the IMF made everybody else in the world do when they had a great financial crisis like we had in 2008, the recipe was straightforward. Break up the big banks, wipe out the equity, bondholders take over the equity, fire the managements, fraudulent issues go to jail or go to trial, and if they're found guilty by their peers, they go to jail, and the system moves on. That would have been a very deflationary outcome to, back to our prior point, the wrong people, the politically tied people. That couldn't be allowed to happen. It wasn't allowed to happen. It could have been, but it wasn't. Okay, the choice then, if we're not going to let the costs of that crisis be taken out of the net worth of Wall Street executives, real estate in the tri-state market up in the Northeast, et cetera, the tax receipts in New York, what have you, then it gets added to the government's balance, the federal government's balance sheet. So that, again, there was no real payback there. We were keeping, the banking system whole after it had engaged in questionable behavior, at least unwise behavior, if not outright questionable, and in certain cases fraudulent. Fraud doesn't get compensated. When you're in a company, you do fraud, you don't say, well, that's still a good asset. It's a fraudulent asset. You bought a fraudulent business. Enron stock didn't stay at whatever, 80.
Right.
0. So we've got, I bring those examples up because I think a way to think about it for just sort of the average person to think about is we've got 30 trillion on our balance sheet, and some portion of it needs to be written down dramatically. It is wasted. It's gone. We spent it on nothing. We put it in a pile and lit it on fire. And yet we're still holding it there. And that then gets into, well, how do you do that? You can write it down, but you can't write it down. In the government world, in the sovereign world, those bonds are still the assets backing other collateral, and you'll go into a debt spiral, basically. Okay. Then the other alternative is you need to write something else up. And so far, we've written up the general price level.
Right.
And that's the way governments tend to do these things. They don't say, oops, we screwed up and look at all these mistakes we made. They kind of print the money, they raise the general price level, and they extend and pretend. And 20 years later, oh, well, it's not that much money anymore anyway.
And that's a very generous way to put it, I think, writing up the price level. I think you would agree, but it's taxing the poor, the middle class.
Yeah, and because you don't have the political courage to admit to what you did wrong. You want to be the man, you want to be the leader.
Yeah.
Great. When it goes wrong, when it gets right, you should get when it goes right, you should get the credit.
Right.
When it goes wrong,
take responsibility.
You should take responsibility. And that's a sort of something we're dealing with, I think, in our culture broadly, right?
Yeah.
It's like when you have, 6 and 8 and 9 figure golden parachutes for companies that are left in worse shape than when the exec gets there, it's probably not capitalism. I don't know what it is, but it's not capitalism. And in the same way, inflation is just how politicians are able to stay in power, keep doing what they're doing without having to admit that they screwed up, and the buck actually doesn't stop there. It's just a compensation scheme for Washington. And it's same as it ever was. I don't want to be one of these guys like, oh, it's Washington's the same as it ever was, which is, it's not fine, but it's fine. Like, okay, great. I know what to do with that.
Yeah.
I'm watching, Bitcoin's at 95,000 because it's same as it ever was. Like,
Have you ever wanted to live in an off-grid community with complete food, energy, and water independence? If so, then you need to check out the farm at Okefenokee. The farm is a pioneering community designed to foster longevity and well-being, eliminating elements that detract from these goals. At the farm, the convergence of nature, nutritious food, a supportive community, and the ethos of slowing down is unparalleled. Positioned at the gateway to the UNESCO World Heritage-nominated Okefenokee National Wildlife Refuge, the farm at Okefenokee stands as a testament to a lifestyle that truly nurtures health and happiness. Unlike conventional housing developments where a token communal garden may suffice, the farm itself is the community. Small, intimate microvillages seamlessly integrate into the fabric of a sprawling agricultural community. So if you're interested in joining this off-grid community, then go to okefarm.com today to learn more about becoming a member. Make sure to tell them that I sent you for a $21,000 discount on their custom cabin pricing. Again, go to okefarm.com to learn more about joining this revolutionary regenerative agriculture community. Forget multivitamins and other supplements. Animal organs are the most nutrient-dense foods on the planet. You can get 100 times more nutrients from organs than you can from muscle meats. But the problem with eating organs is that they are difficult to find in stores, they are difficult to prepare, and even when they are prepared well, they often don't taste great. Thankfully, Heart and Soil Supplements has made consuming organ meats so much easier by providing powderized organs in capsule form. Organ meats include everything your body needs to thrive: vitamins, minerals, peptides, proteins, and growth factors. This is why organ meats were the most prized foods for our ancestors. Fortunately for us, Heart and Soil makes these treasured foods easily accessible. So go to heartandsoil.co today and use discount code BREEDLOVE to get started on your journey to optimal health and vitality. Again, that's heartandsoil.co, discount code BREEDLOVE. Have you ever wanted to start a business in the Bitcoin space? If so, then the Wolf Startup Accelerator could be for you. Wolf is the first startup accelerator dedicated exclusively to businesses developing in the Bitcoin Lightning Network. 4 times each year, Wolf brings teams from around the world to New York City to work with like-minded entrepreneurs, pushing the boundaries of what's possible with Bitcoin and Lightning. The program is designed to help early-stage companies achieve product-market fit, develop their brand, secure early-stage funding, and grow businesses that fuel the global adoption of Bitcoin. Go to wolfnyc.com to learn more or apply today. Again, that's Wolf, WOLFNYC.com. I want you to linger on this point a little bit because you said something there that I thought was interesting, that government is different than business. And I love to quote Nietzsche on this. Nietzsche says, everything the state says is a lie. Everything it has is stolen. So I guess we get into the definition of what a business really is. But ultimately, I think any human organization has to be business-like, right? It has to generate profits to be sustainable over time, which is something like it's solving problems for people in an economically efficient manner. But the exception to that would be a centralized government that has a money printer, because they can deficit spend, which is what we typically call it, but it's really just generate losses and paper tax the middle class and poor through money printing to paper over their losses and continue as a going concern. Can you linger on that distinction? What is this? Because we draw this bright line in the world, like, oh, that's private sector, this is public sector. But reality is there's a lot more continuity between the two. So I want you to just maybe linger on the difference between government and business, if you could.
I'm gonna take an direction.
And what business is the government in? I guess that's a good point to it.
What government is the business in? Or what business is the government in? That's a political question, right? You get a different answer if you ask a Democrat versus a Republican versus a Libertarian. Yeah. To me, the difference can only be maintained between. You can only say the government is different than business in a time of cheap, plentiful energy, where every entity, living thing, organization has to offset entropy, right? Which is just the wearing. You have to keep. I'm sitting here burning calories, thinking and talking, and if I stop, sooner or later, I'm going to fall over dead.
Yeah.
And in the short run, for government, maybe the great fraud or misrepresentation of the last 50 years has been the equation of fiat and energy. They were set equal to each other. And for a long time, there was no distinction. And to be clear, from 1973 to 2003, oil was, for the most of that time, which I'm going to use oil just as a discrete proxy energy. Yeah. Okay. A barrel of oil from 73 through 03 traded the vast majority of that time between $15 and $25 a barrel. We were basically on an oil standard from 73. It was a loose pseudo peg to the dollar.
From the gold standard to the black gold standard.
To the black gold standard.
Yeah.
And that world had its issues. It had the reasons we did it. It helped us win the Cold War because we were printing dollars and the Soviets had to lift the oil and a whole bunch of different things. And then after 03, for a number of reasons, geologically, we had some major supergiant fields starting to roll over in production. We had China coming online with massive consumption. We went into la-la land, like basically, $25, $30 a barrel, $40 a barrel, $50 a barrel, $80 a barrel, $150 a barrel by 08. That's the dollar collapsing. That was a dollar collapsing against oil. Wow. And that's where everything starts to get, that's where the whole, well, we're government and that's business and it doesn't matter. In the end of the day, I'll take that money if that money keeps me, I can take it down to the corner and I don't have to wait in line and I can get 14 gallons of gasoline in my car for a price that I recognize. When that relationship starts to break down, that is where the whole government business line starts to break down, is how I would answer the question. There's a real world dynamic, because then if the government's money isn't good for energy, think about what that implies. The government's money isn't good for energy.
It's fake.
It's not only is it fake, but what are they going to do to you for moving away from it? They can't afford to pay the army. They can't afford to send a naval carrier over off your shores. They can't afford to go to war with you. So that, to me, I think is how I would delineate the difference that's not often talked about between, like you said, you frequently hear this, well, that's government accounting or government, and this is...
And we had separate classes on it in college, as I'm sure you did
too. Yeah, right.
But it's kind of bogus. It's kind of the same thing, just different titles and different style of accounting, but you're still doing the same thing.
Yeah, and so it really is, government deficits end up in emitting cash into the economy, which again is fine. And this is what the MMTers will say, well, just keep spending, the supply will come. That's where it breaks down. Yeah. When the supply doesn't come as fast as the money comes.
Yeah.
And then if that situation persists for long enough, we tie that back to our initial point about the psychological tipping point.
Yeah.
Except at this level of the game, that psychological tipping point is Vladimir Putin going, your paper, it's bad.
Right.
Give me gold. Xi saying, your paper, it's bad. Give me gold, and we're going to start buying our oil and commodities from Russia in yuan.
Right.
And
the bullshit detector goes off.
Exactly. And the difference at that level of the game is like Putin's got more nukes than we do.
Yeah.
And was willing to fight. That's, and I think another big surprise to everybody was, and I'm jumping ahead a little bit, we can come back to that, but was willing to fight in Ukraine. And I think that in a proxy war with NATO. So at that level of the game, when you call bullshit,
yeah,
there's no convincing. You know, it's not like you can get on CNBC or mainstream media and tell people that inflation's only 4 or 6 or 8 over and over and over. Putin doesn't care.
Yeah,
he's selling oil, and if his oil goes from buying him $30 to $60 to $90, and he looks and goes, God, I thought they were going to reform entitlements, and up until 2008-09, and now. This is that psychological tipping point.
Right.
I thought they were going to reform entitlements. They said they were going to reform. They told me they were going to reform entitlements. And now they just printed the money. They didn't handle their banks the way they handled my economy when it collapsed 10 years ago, or anybody else's economy when they're, Southeast Asians 15 years ago, et cetera. They printed the money, and they've got another 100 to 200 trillion to print in entitlements. They're probably going to print it. And now when I say this, now there's more missiles showing up on my borders that I'm paying for by buying their bonds. I'm out. Your money's no good here.
Gold.
I'll take your paper, but then I'll immediately roll it into something else. The Chinese, same thing. I will take your paper, your money, but I will then immediately roll it into something else of use. And that is the tipping point.
I think, man, I think you're touching on like kind of a profound point here, that it's like the extent to which money misrepresents energy. I guess energy could also be a proxy for goods and services, right? Because energy underlies the production of all goods.
Yeah, give me enough energy, right? I flew down here on American, and in American, you did a great job. And if I could afford it, I would have flown down here on a G5, not at 6 a.m. in the morning.
Right.
So that's just a function of the price of energy. If energy was free, I'd have done that, and I would have taken a helicopter right to your front lawn.
Yeah, of course. Yeah. So as you said earlier, right, like the small lie turns into a bigger lie, into a bigger lie. But the money becoming more of a misrepresentation of energy or goods and services is like the spectrum across which it is becoming more of a lie, let's say. Yes. And then people at the highest level start to call that bluff, right? That are
not only do they call the bluff, but it becomes a threat to their national security.
Right.
That's where they're like where we are in the world. And I think this fourth turning is the lie has gotten so big, and it is so obvious that the only way you're either going to have, if you're not going to reduce the obligations to your own domestic political, you're not going to cut entitlements.
Yeah.
Then you're going to print the money. And if you print the money, Putin is in a situation where he has spent the last however many years, Russia's been lifting oil, selling it for dollars, storing it in paper dollar assets, bonds in particular. And he's going to wake up one day and his biggest oil field, Samatlor or whatever it is going to roll over, go 100% water cut. His oil production will fall in half or even more. The price of oil will go from 90 to 300 overnight. And the paper he exchanged in return for energy, he will be out there trying to bid back energy at 70% less energy value than he sold it for.
Right.
And he will be, deposed, best case, killed, worst case, overthrown, whatever. She is in the same problem on the opposite side of the same coin, which is to say he's a big oil importer.
Right. And there's back to the psychological engine, right? Because you get people. So basically Putin's saying, hey, this money is no longer energy.
Yeah.
Give me the money that is energy.
Correct.
With proof of work money, which is gold.
Yep.
And then his contemporaries, his peers, she, as you mentioned, is probably also looking across the table saying, oh, well, Putin psychologically, game theoretically, said, forget the dollar, I'm going to go with gold. What are we doing? What should our position be, right? It kind of induces this imitation across people at that level. And before you know it, and this is where inflation's interesting, that it's actually can just be a purely psychological phenomenon. If enough people think the US dollar is going to hyperinflate, well, then everyone will sell their dollars and buy something else, and that will cause the US dollar to hyperinflate.
Well, and it comes back to that point of you can now what's the lever that's going to hit the bell, right?
Yeah.
So once Putin and Xi started doing that, they're big enough where the global central banks stopped growing holdings of treasuries. Basically, once they stopped, global central banks have not bought an incremental treasury on net since 2014 when they both stopped doing it. That then kind of shifts the pressure, our price discovery over to the treasury market. Okay. Supplies of treasuries, are they going to keep rising? Because right now we've got a cap on price insensitive buyers, right? Central banks aren't buying anymore.
Right.
Yet supply keeps rising. How are we going to fix that? Are we going to cut? If we would have said, okay, this doesn't work for us, we need to cut entitlements by 20%, 30% immediately, permanently, defense 20, 30% immediately, permanently.
Austerity.
Yeah. The problem is in a debt, when you already have run up enough debt, you go into a debt spiral. So that was not really possible. So then option number 2 is you find new buyers as your debt keeps rising. And we found those, right? We regulated money market funds into buying treasuries. We regulated banks into buying treasuries. We incented pensions with a tax benefit under Trump in 2018 to buy more treasuries. Even then, it wasn't enough. We had the repo rate spike. We had Fed do not QE. Then we had COVID, and we did Fed do big QE. And we've been talking about this treasury market dysfunction. We've been seeing dollar goes up, dollar gets too strong, rates start rising, even though the economy is slowing. This is emerging market behavior in the U.S. sovereign bond market. It is precisely what you would expect in a world where sort of the origin story is China and Russia said, we're done buying.
Right.
Central banks, as a result, stopped growing holdings of FX reserves, and the supply of bonds kept rising. Flat demand, rising supply, falling price. Falling price in bonds, yields up. But our debt level is so high, we can't afford yields beyond a certain point. So it gets into this point where they, Russia and China, have acted in their own. It's a matter of national. The lie got so big, the separation from energy got so egregious, they had to act in their national security interests. And it throws it back into our court, which is, oh my gosh, we can't afford all this stuff. Now it's a matter of our national security interest. What are we going to do? And that's kind of where we are.
And yeah, that word national security is very interesting because, as you said, when the foreign buyers of treasuries stopped buying, there was basically no more net increase after 2014. Then we start using the U.S. legal system to, you use the word regulate, I would say legally coerce a lot of these capital pools, and in some cases incentivize, to be more generous.
Sure.
To buy U.S. treasuries, right? Because you need a buyer for that debt to keep expanding all of the government, to pay for all the government programs that are already in place.
Correct.
Isn't that not just a catastrophe? I mean, you're because now all this capital is flowing into the same capital allocator you described that's not allocating capital properly, right? It's not spending it prudently because it doesn't have really an incentive to do so, frankly, right? It's easy come, easy go, right? The money just appeared and we just spend it however we want. Like it wasn't earned, basically. So doesn't that create this vicious cycle where, okay,
100%.
so where does that go? Where does that go and how does that end?
It ultimately, I mean, what is the Austrian economist, the only way out of a debt bubble is by either voluntary abandonment of the debt bubble in question or complete catastrophe of the currency system involved.
So hyperinflation or deflationary crash back to reality, basically.
Yes, and the really perverse thing about this is that we have a debt-based money system now. So even if you chose deflation, it's deflation with an asterisk, austerity. It's with an asterisk, because in a debt-backed money system, once you go into enough deflation that the debt that backs the money starts to default or be haircut, you go through the looking glass into hyperinflation, because people are going to run out of the debt into anything else that holds value at par.
Right.
And so your choices really are high inflation, possible hyperinflation. I don't think we'd get hyperinflation in the US because there is a price. We still are a rich country. We are a very diverse economy. There's oil went up 15x, right? 10x, $15 to $150. And we became on a lag the biggest producer of oil. That's that kind of effect. It's
right
at the right price of everything. We can produce most everything, at least on some level. So it's not like a currency destroying hyperinflation.
Major reserves of resources to back the currency to prevent it from hyperinflating.
So I don't think we'd get a currency destroying hyperinflation. I mean, but high inflation or deflation, which we just talked about, which is not. It'd be deflation for a time until you started defaulting on the underlying the debt that underpins a currency, in which case you might flip back to an actual hyperinflation. There's also sort of productivity miracle around energy. And that's, it ties to me always back to energy. If you have some sort of de facto energy miracle, productivity miracle, whether that's some, widespread commercialization of small modular nuclear reactors. Could that be it? Yeah, it could. Rolled out in an appropriate time horizon, not 10, 15 years. Like, hey, 5 years, we've got one of these things sitting in 40% of the developments in the United States, providing electricity for basically free for thousands of houses, per reactor. Fusion, which is sort of always the fuel of tomorrow, 20 years from now. The UAP stuff that we've seen as a limited hangout in theory.
I don't know what that is. UAP.
These UFO hearings and everything we've been hearing. Have you seen some of this stuff?
I haven't paid attention, no.
So there was a congressional hearing this week in UAPs, unidentified aerial phenomenon, I think is what UAP. It's UFOs.
I've seen some videos, but that's all. Yeah.
So you've seen these military guys, these F-18 pilots. They're like, I just saw something do something that the rules of physics say it can't do. And it's not just one. It's like, I did. I did. If these things are some sort of classified technology that we have access to, that we're kind of waiting until like the Hail Mary moment to roll out or use, that type of thing, that would be a way out as well, right? Where you get, perfect example is, the UK after the Napoleonic Wars, people in the UK are going to be pissed. I get this wrong. I want to say it's like 1815. Those finished up maybe by 1820.
I think that's about right. Late 1700s, early 1800s. So I could also be wrong though.
They were wildly indebted on the gold standard, didn't want to devalue the pound, and they were able to basically earn their way out of it with productivity. That's what an energy productivity miracle is.
Right.
Okay, what was that? Well, we had the historically unprecedented Industrial Revolution, the discovery and commercialization of fossil fuels, the introduction and commercialization on a compressed time frame of wild technologies like the railroad and steel and just all the boom that sort of went from 1850 to 1950 is not even 1950, 1850 to
today,
1925, right? I think about 75 years. Like they went from like horses to cars and jets. Well, I guess jets not in 25, but airplanes, right?
Soon after, World War II.
And jets shortly thereafter. So point being, that's the type of leap in terms of productivity miracle you need to get out of, to have that be the resolution rather than high inflation or restructuring default.
Yeah, so it's something like, and I've talked about this before in terms of money printing, where there's a race occurring. People are always asking, like, how long until X fiat currency hyperinflates? And I like to frame it as a race between kind of what you're describing. It's, well, how fast are you debasing the currency versus how fast is productivity advancing through technological innovation? If productivity is advancing fast enough, then it actually unlocks additional runway for that fiat currency. Because you can basically think of printing the fiat currency is harvesting that productivity that's getting unlocked through technological advancement. Or another way of saying that is the productivity is unlocking new purchasing power for the money. So there's more purchasing power to be reallocated via money printing. But if the purchasing power stalls or stops or regresses, well, then the fraud gets exposed much more quickly and people feel the pain much more severely, I guess would be the point. Are you saying something like that?
I think that's a great way of phrasing it. And it introduces sort of another angle to this whole thing, right? Which is, the friction you just talked about where sort of what I was discussing before, basically with peak cheap oil, where oil went from 15 to 30 to like that was the dollar collapsing against oil from, call it, 2003 to 2008 in particular. That was that triggering sort of losing that losing that friction.
Yeah.
The flip side of it is when you get into things like AI and robotics and how fast do those things happen,
right.
Which not only can they buy you time, like you were in the manner that you just described it, but in sort of I don't even know if the right phrase, but it's like Schrodinger's monetary factor, right? They're buying you time, but they're also costing you time. In other words, they are improving purchasing power,
right,
and they're reducing employment or reducing wages, right? They're putting deflationary pressure on wages, which all else equal is fine if you have an equity-based system, basically, but we don't. We have a debt-based system. And so for every robot that gets rolled in that's going to take a factory job, or every AI that comes out that takes a bunch of, I don't know, programmers out of someplace, the AI doesn't have a mortgage or student loans or credit card loans. And all of those workers, nobody buys anything in our society, cash, basically. The average people pay borrowing credit. And so now we know how that works out. The China shock was a productivity miracle. We took 10% of American manufacturing workers and shipped the jobs to China in 2 or 3 years after China went in the WTO. And we papered over the negative effects of it of the wage deflation and the community rot that caused by giving them subprime loans. Here, I know you went from making 40 an hour plus full benefits at fill in the blank manufacturer, and now you're making $12 an hour, no benefits at Walmart, but we'll give you a subprime loan on a $300,000 house and a bass boat, or we'll give you a home equity line. And that was fine, again, until they raised rates, the collateral fell, and it all came unhinged. And then the true economic cost of offshoring these jobs, the deflationary productivity miracle, almost took down the whole system.
Right.
5-6 years later. So we have a model for that sort of yin and yang of this buys us time by introducing deflationary pressure. But we also have a model for it speeds up the clock by introducing on the debt, by introducing deflationary pressure. AI doesn't pay taxes, right?
Yeah.
Robots don't pay taxes. So receipts fall.
Right. So this is like, it's introducing dislocations into markets, right? Because prices for certain things that AI automates will go down for consumers, but the things that it's automating are professional services typically. So the wages of that category also go down. So it's causing a lot of reshuffling inside of the labor market, which can be, I guess, at the same time inflationary, but also deflationary.
It can be both. I think ultimately, and this is probably why
it's so difficult to talk about it in aggregate, and why people like Mises in the Austrian school say you can't talk in aggregates. You actually need to talk in specifics rather.
Yeah, that makes sense. And this is a good case. That was you're gonna have wage deflation in these areas, and in theory they can re-educate, retool, whatever. Yeah. Practically speaking, that's not how it's worked. Number one, right? Yeah. Learn to code, right? How many manufacturing, the derogatory term, learn to code to these manufacturing jobs that were lost.
Yeah.
Men are stubborn. 55-year-old men, most don't learn to read. Sure. They don't learn to code.
Old dog, new tricks.
Exactly. Yeah. It's difficult. It's very difficult. But it's very disruptive because of the debt side of it. Because again, now you get into a debt-based system where there's deflation for services after we've spent the last 30 years rushing this economy into services. And it's somewhat troublingly, I guess, I would argue that the average white-collar person, I don't think has the same sense of, has felt the same sense of risk that the average blue-collar person has felt from, say, China, right? From the productivity miracle. The blue-collar person is like acutely aware. If you're not sort of like a plumber or someone plying their trade here, plumber, electrician, painter, those types of things. If you're a blue-collar person, you've been acutely aware of this. And I think certain white-collar trades with like IT, I think they're probably more aware of this than, but like the healthcare administrator, you look at the number of healthcare administrators in this country. Like they don't have any idea what's coming. AI's, so system-wide deflationary. Then we get into questions of, do we think the healthcare system is going to pass those through to consumers? I hope so, but I'll reserve judgment. I'm not going to hold my breath.
Yeah, it's not competitive enough, right?
Right, exactly. So maybe that money goes to the insurance, but insurance adjusters, AI can do that. Like there's so much stuff when you talk through that whole chain, it should be deflationary until those people stop paying their mortgage and their car loans. And then the bank goes, oh. And when the bank says that, the bank has reserves to sell against credit losses. They were mandated back in 2014 at holding them. What do they hold? Treasury bonds. We started to see this with Silicon Valley and Signature. Banks were selling down, but that wasn't a bank crisis per se. It was a treasury market problem. They had the money. They were going to sell more treasuries into a sloppy market. So now you're getting into a system that, once again, because it's debt-based and it's been debt collateralized, a deflationary productivity enhancing tool that arrives too fast will break the system. And then you say, okay, well, is it, to answer your question, inflationary or deflationary? Depends in aggregate, right?
Yeah.
If we let the banks go, if we let them just sell treasuries and rates go into market, and it's going to be deflationary, like really deflationary, until it gets so deflationary that treasury bonds start to default, and then it gets hyperinflationary.
Such a whipsaw.
It is, and good luck trying to time that. Number one, but number two, more likely, what's going to happen is there'll be some sort of backstop. It'll be called BTFP, buy the freaking paper or whatever. Where buy the freaking paper was yield curve control for banks. That's all it was.
Right.
They had bad paper. It was treasury paper on their books, and they said, we'll buy it at par, even though it's trading at 60 cents. Full stop. That's what it was. You'll see something like that, to help the banks, which again, okay, it is what it is. It's on some level intellectually offensive, but this is the market we have. This is the economy we have. This is the system we have, not the one we want. It may get us to the one we want, but I think they're going to print the money to keep the debt whole. They're going to have to reserve the debt, and they're going to start with the treasuries, and then they'll move up to the consumer debt. And pretty soon we'll wake up and be like, wow, the Fed's balance sheet's $40, $50 trillion. When did that happen?
It gets back to the whole information component you mentioned about prices, because as this vicious cycle persists, the pricing just makes less and less sense, right? Like you said, when the Fed's balance sheet is $40-50 trillion, you're just like, we're just in Narnia now. Like nothing makes, the numbers don't hold relevance to factual reality.
No, and it's really the original sin if you want to talk about it. You can make the case it was 71 when we went off the gold standard, but I would argue, and I think a lot of monetary purists would argue, it was actually the 1922 Genoa Conference when the US and UK made dollars and sterling reserves equivalent to gold reserves for treatment. They basically, that was the marriage of fiat and energy. And once they did that,
you're saying when there's a fixed exchange rate for monetary metal, the currency was pegged to energy. Is that what you're saying?
Basically, yeah, you have you're tied to energy still, right? There's still, you had to earn it, right?
You're
There's
tied to
still
the
a
energy
physical,
necessary to produce the metal.
there was a proof of work,
Yes,
effectively.
Okay.
Once you said metal, once you went from metal is final settlement to metal or dollars or sterling or final settlement, that was the original sin. There was Jacques Rueff wrote about that. It's interesting. That was 1922. Putin and Xi said there's changes that we're engineering that haven't happened in 100 years last year in 23. So right around that time. But that you can make the case, in my opinion, that what the big lie that is breaking, that is no longer is, all goes back to that.
Okay. So if we're going to use the word solutions, I guess we'll use this term very loosely, but it sounds like it is a combination. There's only like two solutions. The printing of money, right, to keep the debt-based monetary system going on and on and on, which is to say taxing the poor and the middle class to keep the pyramid scheme going. But then there's also the productivity unlock through technological advancement that can actually extend the runway of the money printing and create all these weird dislocations you're describing, right? Where it can be inflationary for some cohorts and deflationary for others. And there's kind of like a quantitative and qualitative dimension to it. I don't know. It's messy. Let's say I don't think it's easy to say it's inflationary or deflationary. As you said, it's much more Schrodinger-like. In some kind of superposition, perhaps. Okay, so if that's the spectrum of possibilities, are there historical examples of this that you think are relevant, that we could bring in maybe examples of other nation states that have faced similar circumstances and gone down a combination of these solution pathways?
The UK one, we talked about it a little bit ago, which, how relevant is 210 years ago, given what we have? But I think it is instructive in terms of the magnitude of productivity miracle. But again, they didn't have a debt-based system. So yes, productivity miracle, you're enforcing deflation on some people. Those people harshly, right? These, you get into Dickensian times, right? Where, hey, you can't pay the rent, go out in the snow and take your kids with you. Well, we might starve. Sorry. Like that productivity miracle layered on that debt system could get them back to that spot because of the harshness of that system. It was very much energy dominant, right? In terms of, you either have the money to pay the rent or you don't. If you don't have the money, you starve. There's no latitude, the fiat, the government backstop, any of those things that we have now that makes it really, really tricky. When you look at the components of our system and where the flows are, and what I mean by that is U.S. government's going to spend, I don't know, about $7 trillion-ish, or just spent about $7 trillion. They took in receipts about $5 trillion. Of those $5 trillion in receipts, $3.3 trillion are health and human services and entitlements, or Social Security, excuse me. So entitlements. About $1.4 trillion pro forma gross is interest. About $900 billion is defense. So we're already at $5.6 trillion on $5 trillion in receipts. We haven't even gotten into parks, recreation, labor, education, veterans affairs, which is $350 billion now after all these silly wars. All this stuff. But if you look at those flows and a cold Dickensian manner, like the fix is easy. The fix, I say the fix, and I want to be clear with this because this is,
fix in air quotes.
Yeah, it's you get rid of $3.3 trillion in entitlements,
which is breaking promises.
Just breaking promises. It's a default.
Yeah.
So now those broken promises in theory could also be kept by early death. Kept but restructured by early death of the people involved. Not something I'm wishing for, not something I'm hoping for.
But there's an incentive for it.
there's an incentive for it in theory, right? I mean, if you are a sociopath, then yeah, there's an incentive for it because if the 3.3 trillion very much, particularly on the Medicare Medicaid side, very much abides by a Pareto principle, 80-20 rule. Some enormous percentage of Medicare Medicaid spending takes place in the last 6 months of life with people who are very unhealthy and aren't going to live much longer. And so if something happened where the sickest 30% passed on quickly, got sick and died quickly, then mechanically, what happens to those flows? You get much less outlays.
Right.
Their wealth flows to their kids. Their kids are able to pay off debt or get out of, practically speaking, their kids are all Gen Xers, and Gen Xers are in their peak spending years where they got, so you're going to get a multiplier effect and
massive estate tax receipts.
Yeah, it's just like horribly dark. I don't think it's happening. I don't even really like talking about it. But again, if I'm an objective analyst and I don't want to be the guy who says, well, it's either inflation or default or high inflation. There's no other way out. No, there's also sort of, this messy disruptive technological thing, but there's this other thing that, you start dancing around some very uncomfortable issues. I don't even like talking about it. I love my parents. I love my in-law or my mother-in-law. My father-in-law's passed on, but but again, as an objective analyst, are there sociopaths that would think about those things? I don't know.
Well, look, and I wouldn't like to go down this too far, but I couldn't help but feel the recent years we've lived through. And I mentioned Dr. Jack Kruse to you before we started this conversation, and that was one area I didn't mention, but he leans into that particular, I would call it a malincentive, if you're looking at it from a human perspective. When one group of humans gets paid when another group of humans dies, that's bad.
Yeah, right. You can't buy life insurance on me, and I can't buy it on you for that exact reason.
Exactly,
right.
Exactly.
We don't have any insurable
So it's
interests.
a misaligned incentive or a malincentive of sorts. And you use the term sociopath. And, I would say there's strong evidence, and we don't have to belabor the point or go into it too much, but I would say there is strong evidence that there is some sociopathic tendency at certain levels of government.
And that it's overrepresented, right? Because it actually plays well in those organizations. Corporate America, too. I remember seeing a study one time where they said they estimated up to 10% of high-level corporate execs are sociopaths, where it's like 1% or less in the general population or something like that, because they tend to be very smart and ruthless, for lack of a better word.
Yeah. So it's like the insects to the lamp, right? The lamp being the power and the sociopaths being the insects, they're drawn towards it. And we'll just skip the point. Let's move on from
that because it can get
just for the audience. Dr. Jack Kruse, who I will be talking to soon, does go into this, and I think it is interesting, but not for today.
Yeah, not for today.
Yeah. One of my highest health priorities is keeping my brain in top shape. To take care of my brain power, I do many things, such as striving to read, write, exercise, and meditate daily. One of the latest tools in my brain power toolkit is MindLab Pro. MindLab Pro is a nootropic supplement that is scientifically proven to enhance your brain power. When I take MindLab Pro, my mind feels like it has a better grip on the world, my thinking is more lucid, and the articulation of my speech is radically improved. MindLab Pro has been tested in rigorous, double-blind, placebo-controlled human trials and has been proven to enhance brain power for users in every age group. MindLab Pro is an advanced formulation of 11 nootropic ingredients and is backed by research from over 1,400 human trials conducted over the past 32 years. So if you're looking to enhance your brain power, MindLab Pro is an excellent solution. Go to mindlabpro.com/breedlove to start enhancing your brain power today. Again, that's mindlabpro.com/breedlove. Before starting the What is Money show, I spent most of my career as a CFO, overseeing internal technology implementations and business acquisitions. Over the next 10 years, it is projected that over 12 million businesses in the U.S. will be sold. If you are an operator running a business generating between $5 and $200 million of revenue, and you're considering selling your business within the next decade, then there is a significant opportunity for you to deploy technology to streamline business processes, reduce operating costs, and enhance the multiple your business ultimately sells for. To this end, I am partnering with the team at Emerge Dynamics, a firm with decades of experience in maximizing the value of privately held small and middle market businesses. Go to emergedynamics.com/breedlove to learn how you can build an attractive, high multiple company that maximizes your return when you fully exit. Again, that's emergedynamics.com/breedlove. This December 17th to 21st, 2024, join me on the Pacific coast of Mexico for our men's retreat, The Art of Alpha. At this world-class retreat center, we will have daily meditations, movement practices, yoga, cold plunging, infrared sauna, and many other biohacking modalities, all while enjoying world-class cuisine designed for optimal full-body health. The retreat center is a gorgeous biohacker's paradise located right on the ocean. You can think of this place as a nervous system reset facility. At the Art of Alpha, we are seeking men who wish to cultivate freedom, wisdom, sovereignty, physical fitness, truth, and love in themselves and in those who look up to them. If you've always felt motivated to push yourself to new limits to discover the best version of yourself, but you've struggled to find the right community to immerse yourself in, then the Art of Alpha is for you. To apply to join the Art of Alpha, go to breedloveevents.com. Again, that's breedloveevents.com to apply to join us for the Art of Alpha on the Pacific coast of Mexico this December 17th through 21st, 2024. The debt to GDP we're facing is like 140%, we said, without the unfunded liabilities.
It's about 125% without, on a gross basis, yeah.
Okay, where does that put us? I mean, we're going to use the baseball analogy of what inning we're in, which so many people like to use. And I know you said you didn't think US dollar hyperinflation was likely given the extensive reserves that we have. But what I guess maybe abstracting away from the United States specific example, what does 125% debt to GDP look like in terms of baseball innings for where you are on the path to hyperinflation for your typical country historically?
For an emerging market, and the other thing too is we're twin deficit, right? By virtue of we have the reserve currency, we have to be twin deficit. But if 125% twin deficit, that was Argentina, 2002.
Mm-hmm. Could you expand on that too? Twin deficit. Yeah,
twin deficit is trade deficit and fiscal deficit together.
Oh, okay.
Yeah,
gotcha.
Yeah, so you're running both. Yeah,
is this related to Triffin's paradox?
Sort of tangentially. It's basically, it's a current account, your country's current account, right? Mm-hmm. So you basically, if you have a twin deficit, you're not earning, if you have a surplus, fiscal or current account surplus, you're actually earning money, right? So like Japan,
importing more than you're exporting.
Right,
or,
exactly.
I'm sorry, exporting more than you're importing.
Correct. Yeah. Yes. So you're in the black in terms of your net flows on an annualized basis, which makes it easier to service your debt.
Right.
That's why that's important, because if you're a twin deficit nation and you have the 125%, normally, you need to refinance what you have and you're borrowing more and your rates are going up and it's very bad. And so historically, twin deficit nation, 120%, like you're dead. You're gonna have a debt spiral, you're gonna have a currency crisis. It hasn't happened to the US because we have the reserve currency. And broader, that tells you you're very late innings, right? You're very late innings. Specific to the US, I think it's very late innings too, because, and again, not necessarily towards hyperinflation, but towards significant inflation and currency depreciation against sort of that physical world, right? That stuff. Because of those obligations, which are entitlements, interest, which are just, the current portion of both, last 4 months, they're running at 103% of receipts. Mm-hmm. And so historically, You had a number of different graybeards telling me this. Historically, once you have to print the VIG, once you have to print the interest,
yes,
you're done.
Moneyball the interest.
You're done.
I've heard this too.
And so
Makes sense, by the way.
it makes perfect sense, right?
Because
Like,
you're talking about just the amount of money necessary to service the existing debt accumulation. You can't even afford that. So like the rough analogy might be something like if you had a $100,000 income and you had, $120,000 worth of credit card interest payments every year.
You're done.
Right? You're done.
You're done.
Like, you're not going to make that.
It's over. So last 4 months in aggregate, that's where we're at, 103%. And it's going to get worse because you're still repricing interest from the Fed's rate hikes. And it's going to get worse because there's still boomers aging and healthcare is getting more expensive, not less. With a caveat. The release valve is the dollar. And that is to say inflation, because inflation will drive nominal receipts up. So if we get a new spate of inflation, a new spate of dollar weakness, the $2 trillion deficit that we just had to end last year will be much smaller deficit if the dollar falls enough. So DXY on the dollar, we'll just use that, is call it 106 today. We ran a $2 trillion deficit last year. If it's at 110, we're probably going to run a $2.5 or $3 trillion deficit. If it goes to 90, we'll probably run an $800 trillion deficit. If it goes to 65, we might run a surplus. And so that is when you say, where are we in innings for the US? Like the way you get to extra innings, the way you keep the game going is you're going to have to let the dollar go. You're going to have to inject dollar liquidity. Right. And critically, where we are in the game, where we are 103% of receipts just for the interest and interest-like obligations, paradoxically, that's going to force the dollar up in the short run until we print enough to get it down, basically. And so it again leads to this very binary, dollar up, dollar up, dollar up. Then once things break, they're not going to break like that. They're going to break like that. You're going to see what we saw. If you liked your 70 basis point increase in the 10-year Treasury yield in 3 or 4 weeks, you would love how fast the 10-year would rise if the DXY went to 114. It would be 70 basis points in a week. And if it went to 120, it would be 70 basis points in maybe 122. If it went to 130, it would be 70 basis points maybe in a day. Like I'm being hyperbolic to a certain extent.
Yeah, sure.
But
but it sounds like treasuries could start acting more like shit coins.
Arguably, they already have been, really.
Yeah.
And again, and that maybe is a great way of framing like what is like the real end game in sort of when you talk about it. Okay, if moving the dollar gets us to extra innings, the game still has to end in theory.
Yeah.
The structure of the system, the indebtedness of the system means that the weaker the dollar is, the lower the deficit is. And therefore, there'll be more buyers, paradoxically. You wouldn't think this, but there'd be more buyers for the less issuance. So yields will be relatively well behaved. But the dollar going to these levels means inflation is going to pick up on a lag. And so there is a dollar level, right? What we're talking about is the higher the debt goes, the lower the level of dollar that we can afford where the treasury market doesn't break, where the yields don't we lose the long end. And that was 114 in the third quarter of 22, and it was 107 in the third quarter of 23, and it's right around 106 now, maybe even a little lower. Let's use 106. So that number's going down, which makes sense. As your debt goes up, your sensitivity to too much debt goes down, right, in terms of the currency. The flip side is the price of the dollar that you need, or the level of let me put it this way, the level of rate that you can afford keeps going down too with the higher debt. But the level of inflation with the weaker dollar so that you can afford the debt will be going up. And so you've got a pincher movement. Weaker dollar, the level of dollar weakness to drive too much inflation keeps going up because the debt keeps going up. And the level of dollar that creates treasury dysfunction because of too much debt and not enough balance sheet keeps coming down, Whenever those two things get too close together and meet, that's the end of the game. That's where you get, things will get weird.
That is interesting. Okay. The term endgame, so I think this may be one of the first times I heard your work, actually. You were on a podcast series. Oh, you're going to have to remind me who it was. I think it was...
Might have been...
it was the Dollar Endgame.
Yeah, probably Eric Townsend.
Yeah.
Like 2017 or something with Mark Yusko. And
yes.
I think Jeff Snyder as well was on that, I believe.
You guys did. I don't know. It was a lot of hours, right?
It was a lot of hours. And I usually absolutely abhor the game Endgame because I know. It's like...
Well, that's what I want to actually... So anyways, I wanted to, first of all, mention that because that was a great series. I think even the... Obviously, it's a little bit older now. That series is maybe
it's like 7 years old.
7, 8 years old.
Yeah.
However, you guys talk about a lot of timeless things in that series, so people could check that out if they're interested. But that term "end game," I agree. Like we're always trying to think about the end game, but it's really an infinite game that we're playing, right?
It's just where the rules change.
The game
rules
evolves.
of the game change.
Exactly.
Yeah.
The rules evolve over time. So I want to set all this up for you because I want to be just very clear about where the questioning is going. I want to ask you, given all of the current game dynamics you've described, we've talked about the market as a psychological engine. We've talked about the geopolitical considerations that go into weakening dollar and all of these aspects. I want to ask you two things, but one first. How does gold fit into this picture? We already mentioned Russia has been a major buyer of gold. I think China has been the biggest producer and importer of gold for some period of time, or maybe if not the number one, close to it. So they're obviously playing that game. And then the second thing I'll ask you, which is after this, how does digital gold play into this game? So we'll start with gold. How does this fit into the picture you've laid out so far?
So the picture... where the rules change is really sort of when that is sort of your paper is bad moment mathematically for everybody. Mm-hmm. As we near that moment, you will see various actors move to some other store of value. Mm-hmm. By virtue of the world that engages in global trade, economic activity, there's always going to be savers and debtors on net.
This is just, you're saying like the people, again, as the money becomes more misrepresentative of energy or goods and services, that people will start to prefer the money that represents energy.
Reserve assets that represent energy.
Okay. Yeah.
And gold to me just represents energy. It's just a store of value it's a neutral reserve asset. It's a 0% yielding bond of finite issuance and infinite duration with a flexible face value, which is superior basically in every way to a treasury bond, which is infinite supply, finite face value and finite duration. Yeah. So
centralized, decentralized.
It's all of that. Exactly. Right. So that's where I think gold flows into it, which is just, there's a game theory of it, which is whoever panics first panics best.
So the incentive is to hit the exit door first.
Hit the exit door first, with the caveat of doing so is going to make you persona non grata amongst the rules-based global order, whatever that means these days. Which we've clearly seen, right? Like, we loved China while they were breaking American unions for us. And now they're breaking Washington and breaking politically connected parts of the U.S. economy, national champions, and we don't love China anymore. We're green until the Chinese make an unbelievable green car for 40 grand. And then we're not such a fan. So I think gold is just, it's stored energy. It's a sort of the original proof of work, and it is a neutral reserve asset that allows you to preserve and arguably grow energy. At the very least, preserve energy purchasing power. Sure. Right? You can see that gold has been relatively steady. Barrels, gold to oil ratio has been relatively steady for centuries. In the same way that the dollar to oil ratio was steady from 73 to 03.
Right.
The Americans basically made the treasury bond as good as gold for oil. They made the dollar as good as gold for oil for 30 years. And then it broke. And once it broke, there was this intervening period. And then starting in 08, Putin's like, yeah, we're out of here. And then China was like, we're out of here. And increasingly, you're seeing more and more nations do that out of enlightened self-interest, which is that we can't, we will not survive as a nation. I will not survive as a leader if I let the representation of money and energy get too far away from each other. And so the way I protect that is I buy gold. And then the digital side of it.
Sorry. Before we go there, though, no, you said so many good things. The game theory component, right? So there is the incentive for an individual, business, or nation basically to defect first, right, out of the money printing ad infinitum game into the gold game, right? Because you're basically front running what you think other people. Well, if this thing's going to keep going, you're just going to keep printing this thing ad infinitum. Well, then everyone's going to end up here in the money that no one can print, which is gold. So the first one to do that will benefit from the later adoption of those, the anticipated later adoption of those.
Correct.
Right. So the first one to hit the door wins. But that, and so that is the incentive to defect from the game, right? So we're talking in terms of prisoner's dilemma game theory.
There's the rules are different for the different prisoners.
Right.
In other words, and this frustrated a lot of gold bugs for a long time, myself included, which is you are free as an individual to defect out of the game anytime you like, but don't expect gold to do what you want it to do or think you should do, because to tie us back to our original point about capping price and psychology, gold is a psychological Pavlovian bell, and they don't want it ringing. And the way they ring it is they create lots and lots and lots of unallocated paper gold claims, primarily centered in London. And so, if a bunch of people opt out of the game, there's two ways to respond to it. You let the price of gold go, which is a market.
Yes. Hey,
you're spending too much money, or I'm a policymaker, blah, 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 blah. Let's just kick it down the curb, kick the problem down the road. And you create, rather than letting price rise, you let unallocated paper claims on gold rise. And that went on for a very long time.
Yeah.
The rules are different for different players. What I mean by that is there are certain players that when they want their gold and their defect, they're going to get their gold.
Yeah.
That has two implications. I think the first implication is still very poorly understood across Wall Street and by most investors, even including some gold investors, which is in late 2012, early 2013, somebody showed up in London who could not be denied delivery and was told and told London, give me my gold now. And you can see it. You can see it in London and UK trade statistics. The UK was exporting so much gold from 2013 through the end of 2015 that the UK at various months actually turned into a surplus. They were a surplus country. That never happens. That's how much gold they were shipping. Where was it going? It was going east. It was going to China. So by preponderance of the evidence, the Chinese showed up late 12, early 13 and said, we're done here. Give us our gold. It matches up with the time horizon of when they said we're done buying treasury bonds, when they stopped buying treasury bonds later that year, and then early 14, respectively. But a weird thing happened because that paper gold market, again, this gets back to when you start, the lie gets bigger, bigger, bigger. When China showed up in London and said, give me my gold, as a party opting out of the system, not able to be denied or papered over, they broke the system. They broke the paper gold system, which is to say the price of gold crashed in 2013, not because nobody wanted gold, but because the wrong somebody who couldn't be denied delivery took the gold, wanted it, give it to me. If you built up an edifice, right? So we just said that they over years, decades, they built up an edifice of paper gold, unallocated paper gold claims, 100 ounces per physical ounce, let's say.
100 to 1,
maybe
liabilities to assets.
Yeah,
right.
and there were estimates of more. There were estimates of less. But let's just use 100 because it's an easy
massive
number.
Fractional reserve.
Massively but that's how they capped gold's price.
Right.
I'll phrase it thus because it's easy to understand. If you have a 100-to-1 fractional ounce system based on 1 ounce, and China shows up and takes the ounce home, what's the value of all the other paper promises?
0.
Nothing. Gold crashed in 2013. Now, mechanically, why did gold crash? Because when you remove the collateral out of a highly leveraged system, what ends up happening, especially when the bullion banks manage it by being, they borrow short and lend long in that market. Now they're upside down. So the gold curve, the gold forward curve was inverted, which means they needed to get the front end of the gold curve down relative to the back end because they're borrowing short and lending long. So they're bleeding money. So what do? Bang, 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 bang. They bang down the front of the curve. And then China shows up and goes, great, you just lowered the price for me. I'll take more. And now it's, so mechanically, that's why it happened.
That's so counterintuitive too.
It is very counterintuitive. Yeah. The way to think about it for the casual observer is this holiday season, watch It's a Wonderful Life.
Yeah.
Right? And pay particular attention to the bank run scene. So when they have the bank run scene, everyone wants their money. There's the one stubborn lady or guy who settles at par, right? But everybody else, what do they take? They take a discount.
That's right. Yep.
So when Lehman didn't have enough collateral to settle its claims, Lehman's bonds didn't go up. They went down. The same dynamic here.
Right.
This was the collateral was being removed, and the impacts of that were hurting the price, the paper price that set the prices we saw on our screen.
Right. So it's like credit risk and the custodian manifesting more so than it is actual price discovery for real gold in a way.
I had, by virtue of what I was doing at the time, a relationship with an individual who would have rated a top 20 sovereign in terms of physical gold holdings. Allocated the whole 9 yards. Like, get on a jet, go check the vault every so often. Goldman Sachs came out in 2013, I want to say April, sell gold. Very aggressive call, very unusual. And gold proceeded to fall like 7 sigma. Like it was like unprecedented crash in the price of gold. Goldman ends up calling this relationship of mine, saying, hey, you saw our call on gold, we're negative on gold, blah, 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 blah. With that said, we stand ready to buy anything you want to offer us. Which only further supports the negative gold forward rates. Later that year, at the end of December 2013, Ken Hoffman, Bloomberg's commodities reporter at the time, gave an interview on Bloomberg TV in which he said the London gold vaults had been emptied, all packed up and recast in Switzerland and shipped on to China, never to return. His words, not mine. So, long-winded way of saying, I just think a lot of this stuff is super interesting background. When a player who cannot be denied shows up and opts out of the game changes. And that was, I think, a change in the game. Gold prices didn't fall in 13 because nobody wanted it. It was because too many people wanted it, right? The GLD's gold inventory went from like 1,300 tons to like 600 tons over the next 2 years. Where'd it go? Where'd it go? No one wants it. Why is it? It went somewhere. So that the who opts out of the game is very important.
Right.
And how they opt out of it. And I think to finish the point, there's the mechanical impact, but then once energy opts out of it and energy begins bidding for gold, that's when things get interesting. And that's where you start to see true price discovery. And that's where I was going to go with that, which is when Putin started shifting to gold, an ounce of gold bought 8 barrels of oil. That was 2008. Today, an ounce of gold buys 40 barrels of oil. And I think it's going way higher. I think it's going to 100, and then I think it'll probably go to 200 over time. I mean, this isn't like, hey, go buy gold because it's going to... And I don't think oil's going down a whole lot in price because U.S. shale doesn't really work too much below 65.
Right.
At least the marginal barrels. And it's got a big decline rate. So there are players, you can opt out anytime you like.
Right.
You can never leave the system unless you are big sovereign with nukes, with a factory base, with a lot of energy.
Right.
Unless you are Russia and China, and that's it. Because now it gives them a whole lot of flexibility. Think about it this way. If you're China, and China can buy oil in yuan from Russia, here's some yuan, Russia. Russia says, great, I've got this yuan. Now what do I do with it? Pre-Ukraine war, I'll buy Huawei equipment and all kinds of stuff. You're the factory of the world, China. You're making it for me anyway. Great. Here's it back. A virtuous cycle of trade. You end up with these imbalances either way. Let's settle it in gold. Okay, great. Oil is basically bidding for gold in this arrangement, right? Because generally the oil exporter ends up being the creditor on trade. As that happens, so that's going to bid up the price of gold relative to oil. Is China unhappy about that? Not really, because their people own a bunch of gold, and gold going up is relative to commodities, is productivity enhancing, your living standards improving. Okay, that's good for us. And oh, by the way, we've got a bunch of gold, and so our oil's getting cheaper, and we need more oil to keep everybody happy. And is Russia unhappy about that? Not really. They bought a ton of gold at 8 barrels an ounce, 9, 10, 13, 14, 20 barrels an ounce, and now it's 40.
All right.
So they're replacing their oil reserves in the ground that the Americans are trying to debase by printing money with gold that is going up relative to their. It's a great trade. And if there was ever a war, which it turns out there was, and something happens to Russian oil sanctions, they go to China and be like, hey, we need to replace some of our reserves. Instead of 40 barrels an ounce, how about 60? Chinese will be like, friggin' great. We get more oil for the same gold. And the Russians will be like, the gold we have here just replaced the reserves you stole by freezing them. You revaluing it using our oil. They're sovereign. They're sovereign. They're decentralized.
Right. That's the key word, right? Because as you're describing the amount of oil they can purchase per unit of gold, right? Their purchasing power is going up, and that's the game. It is a power game ultimately, right? Money is power, right? And so the money that holds or accrues the most purchasing power over time is going to be the one that is most favored. But you're right. There's a qualitative distinction between which player can do what. I mean, I guess you even as an individual, you can technically take possession of physical gold and opt out of the game. You
can, but then you just simply have no choice as to, you're still in the game in that paper because they decide when the paper market, right? Basically Putin, Russia, somebody with oil, nukes, and factories has to decide when the game's going to break.
Got it.
Versus
the paper gold game.
The paper gold game.
But they are also breaking the paper gold game, if I understand you correctly.
Who's that? The Russians and the Chinese?
Yeah, Russia.
Oh, they did break it. Yes, they are absolutely. I think they basically are in control of the gold market.
Okay,
now.
So then eventually I would assume whatever catastrophe needs to take place, at some point the paper gold market would actually break, right? And no longer what's old saying that when the tide goes out, you find out who's swimming naked, right? When things really get bad, World War III or whatever the calamity is, people will all, like countries will demand physical gold only, settlement in physical gold only, right? Promises to gold wouldn't even be acceptable.
Yes, the game will, you'll see when who's swimming naked, when there's that demand where only physical will do. Now, what I think is interesting is, I think the paper market basically broke in 2013 when China did that.
Right.
We then proceeded to see a series of events that one possible interpretation, it's my interpretation, but I think it's a reasonable individual would come to a similar conclusion, that Western sovereign and multinational regulatory authorities have been basically encouraging the too big to fail banks to get on sides. In other words, wind down that paper gold market because that moment is coming. And so, for example, JP Morgan, long thought to be basically sort of, It's the United States, right?
Who said something like gold is money, everything else is credit.
Right. Originally, the JP Morgan said that. And JP Morgan Bank today, September 2019, their precious metals trading desk gets charged under RICO, racketeering charges by the U.S. government, criminally, not civilly, for actions in the precious metals market. Why would the federal government of the United States go after its biggest bank's trading desk for manipulating gold when all conventional wisdom is that the more gold is stepped on, the better for the American government? That was sort of signal number one to me. The next signal was the net stable funding ratio changes advocated for by the Bank of International Settlements, BIS.
Net stable funding ratio.
So it's bank mumbo jumbo. What it meant was, what it effectively said was, banks need to wind. They not only need to, they mandated rules that made it uneconomic for the banks to continue to hold large unallocated gold positions because they had to finance them differently. And so basically, they were upside down. They needed to wind that business down by 2022 or 2023.
Does this mean they had to liquidate the gold or lend it out or what?
No, it just meant they remember they've had the gold here and you've got the big thing of paper.
They need to wind down the paper.
They had to wind down. They had to get on sides. They didn't want them. And it was interesting because they said gold represents a systemic risk for the banking system that we're trying to mitigate. And what I said at the time was, the only way gold represents a systemic risk for the banking system is if the price of gold goes up a lot quickly, to your point. Yeah. And so here we have them, again, get on sides. Then we have the curious case of JP Morgan and the GLD. GLD is the world's biggest gold ETF. I look at it as the world's biggest freestanding pile of gold. It's non-sovereign, 800 some tons, I think. It was founded in 2004, launched in 2004. 18 years, one custodian, HSBC Bank. Headquartered or the vault in London. December 2022, JP Morgan decides it's going to be the second. It becomes the second GLD custodian. JP Morgan then says we're going to move some of the gold out of London to Zurich and into New York. JP Morgan then proceeds to take over half the gold into its vaults by mid-2023, and it's according to some sources, 80 to 90% of the gold in GLD is now in JP Morgan vaults. In under 2 years. So from London to Zurich. Some from London. Mostly to New York. Yeah, some from London to there's, it's still mostly in New York, London, I believe. But it had never been anywhere but London. Right. And then all of a sudden JP Morgan was talking about taking some out into Zurich, into New York. But now 80 to 90% of the gold in GLD is custodied by JP Morgan, not HSBC. After 18 years the most innocuous explanation to me is, in light of the other stuff, is JP Morgan knows the price of gold is probably going to go higher over time, and they can pick up fees at a big discount. And so far, it's looking great, right? Gold's gone from, I don't know, 2,000 to 2,700 in 2 years. So you're up, if you were making 30 bips on 2,000, now you're making 30 bips on 2,700. That's not nothing. So there's just this series of events that suggest to me that moment is coming or could come. And who knows what that moment is. Okay, so that's very interesting. The reason I posed this before, I want to do gold and digital gold, is because I want you to take the contours of what you know about the gold game thus far, and if we could try to do like a reimagining of what this game would look like with digital gold rather than physical gold. For instance, we've danced around this point a lot, but it's probably pretty obvious, right? The paper gold market has been a big problem. Basically, it's a again, back to the beginning, a misrepresentation, right? You've got 100 to 2. I've heard it's as high as 200x. It could be. Yeah, nobody knows the number. And nobody really knows. Governments have used this as a scheme to suppress the price of gold, to uphold the integrity of fiat currencies. You could check out gata.org. They've done a whole bunch of work on this.
presumably, like if I'm reimagining this game on a Bitcoin standard, that wouldn't work so well with Bitcoin because there's not a financial incentive to centralize the custody and abstract Bitcoin into a paper derivative to make it more transactable because Bitcoin's already digitally native, for instance. So presumably the paper market price suppression of Bitcoin would be less viable. I don't want to say it's impossible because we've got Bitcoin ETFs and we've got paper Bitcoin floating around too. And the tide hasn't gone out to show who's swimming naked yet. So, maybe people haven't experienced enough pain to learn that lesson. But at least it seems like the market would say reset more efficiently on a Bitcoin standard rather than a gold standard. So I just say that as kind of an example. Like I want you to think out loud and linger here on what you a reimagining of what this world that we're in and or going into could look like with the addition of Bitcoin into the already complex game dynamics.
So I think first off, Bitcoin has been easier for the average person to opt out of and have the price respond. Mm-hmm. It's more of a true market. I've called it the last functioning smoke detector. I remember having a drink with one of the world's biggest physical gold traders, and it was in New York, probably 2017. So it was when the sort of the first big run in Bitcoin to like 17,000 or wherever it eventually peaked out at. And he looked at me and goes, Bitcoin's just doing what gold would be doing if it didn't have this gigantic unallocated paper market attached to it. Exactly. So there's that dynamic to start. Bitcoin would have to be a whole lot bigger to be gold in terms of, if you wanted to contain Bitcoin, if you wanted to try to run the gold playbook on Bitcoin, the ETF model would certainly probably be the most likely way to go about it, which is to say, pay the bribe, centralize the custody, and then, try to strangle it in the crib while you have it all in custody, if you can get enough. And when I say pay the bribe, I mean there is, in theory, a price where people will let their coins move.
Yeah.
And, that is a way, conceivably, that could be done.
Yeah, because part of the gold paper game that's being played, it's premised on central banks owning 20-25% of the total gold supply. Whereas right now with Bitcoin, they don't have anywhere near that.
They don't have enough.
But an ETF could be an avenue to that.
Exactly. Where suddenly, they, too big to, because, practically speaking, where's it all going to be custody? I don't know if it'll all be at DTCC or wherever it'll eventually be, or all at BlackRock.
I think 10 of the 11 ETFs are at Coinbase custody right now.
Okay.
Fact check me on that, but
I have no idea. I have no idea. So and that's a very good point, right? Mm-hmm. But that in theory, I tend to blur the line sometimes between central bank and too big to fail because, psychological, tipping point that we started off with. I don't know that there's a whole lot of difference, right? In critical moments, certainly. Yeah. So those would be I think the ways that it's different and the ways that it's similar. The other thing that I think is different is the rapidly growing industry for creating businesses, apps, applications, what have you, that require the Bitcoin to move as sort of collateral, right? Lightning Network and some of the stuff, or whatever, however you do it,
needs a transaction layer.
Exactly. So So if the Bitcoin's moving, that makes the ETF get a critical mass and centralize it and strangle it in the crib. That makes that game plan much harder to run out. And that's also very different, right? Because, and the other thing too is it's so much easier to buy Bitcoin than it is to buy gold. Still, real, actual, physical gold. You can have a brokerage account and buy paper gold, but to actually get a physical gold coin, people ask me all the time, they don't know how to do it. And they're in America, and it's hard to do. Bitcoin, once you have it set up, it's a very decentralized way of doing it. You know, you don't have to go anywhere. You know, buying gold online once you have a reputable broker, that's pretty easy too, to be honest. But most people don't know how to do it. So it's a very decentralized. And then the round trip is also cleaner for Bitcoin. In other words, when it's time to sell the gold, that's actually a little, it's kind of a pain in the butt, right?
Physical gold.
Oh yeah, physical.
Yeah,
yeah.
Sure.
Yeah.
So if you're thinking about game theoretic perspective of governments, central banks, whichever aperture you want to approach this through, we know of the games, as we've talked about the games they've played with gold as more or less a protective strategy, right? To preserve the integrity of fiat currencies, you needed to, own some gold and suppress its price in the paper markets. Bitcoin emerges, you don't have a big toehold in that network from an ownership standpoint. It also poses a similar threat to gold, to the integrity of fiat currencies. How do you think they will play this game? I think that we've already heard rumors of BRIC countries talking about mining Bitcoin. We've now got the US, we got Trump elected. He's going to start stockpiling Bitcoin. Apparently there's legislation being drafted for that. Like, just think out loud through that maze of possibilities.
So I think some of it is a rule. It goes back to the rules changing, right? So when we separated energy and fiat, that was forced the Russians and the Chinese to do what they did with gold. Okay. That then starts to force other movements. And when I say the rules of the game are changing, there's still, I think, many market participants, if not most market participants, that are thinking of this still in strictly financial terms, the game theory. But I think the DoD, I think the national security apparatus is now really running this game for the West and for the US in particular. In other words, they don't give a crap about the fiat currency system.
Okay. So you do think it's become a national security issue?
Yes.
Bitcoin. Okay.
Yes.
Interesting.
And the reason the fiat currency system as it exists has been being used by China specifically to undermine, and look, let's be clear. We let them do it. We wanted this system and now we're getting it good and hard. You can't send your factories there. Sure. And you can't send all this stuff and love it while they're breaking your unions for you and then go, oh, you innovated and now we can't compete with you. And by the way, using that dollar system the whole time to basically, oh, America send us dollars. Great. We're going to take those dollars and we're going to go buy up, we're going to leave the game, right? We're going to go buy gold. We're going to buy copper mines. We're going to buy lithium. We're going to buy the port of Piraeus in New Jersey. We're going to, all this stuff that is sort of not dollars. And then we're going to reorder the game the way we want it to. And so I think there's still a lot of game market participants thinking, well, it can't be gold and it can't be Bitcoin because both of those things undermine the fiat system and they undermine the bond market. And I think there is a rapidly growing sect, if you will, of the defense and intelligence establishment that are going, we didn't ask the bond market for permission to fight World War II, and we ain't going to ask the bond market for permission to do this again. We're going to dictate to the bond market. And I think within that dynamic, which completely changes markets and what the conventional wisdom of what's likely to happen in markets and policymaker responses, then the game theory changes entirely. Okay, they're using gold. Well, we can call up a chart of Bitcoin over gold, and we can see on very high face-peeling volatility, Bitcoin has destroyed gold. So let's say, okay, we can go to gold. That's one option. And if we go to gold, yes, that undermines the dollar system, but the dollar system is undermining our defense base. The United States, NATO, lost in Ukraine to a nation with 1/10 our GDP, as everyone made sure to notice and highlight, because we couldn't produce shells, missiles, etc. This is now a national security threat. What do we need to do to be able to produce shells, missiles, defense industrial base in sufficient quantity? Simple. The fiat currency system of the last 40 years has to go. It has to. The post $71 system, reserve status system, has to change to a system with a neutral reserve asset. Has to. And this, I want to be very clear, is very well understood at certain high levels in the defense and intelligence world. It is very well understood. And so they don't care that the fiat system's getting undermined anymore. They don't want to be too disruptive, whatever.
Sure.
You have to mine markets. Markets are still going to exist.
Right.
And nobody said, well, the bond market said we can't go fight in Germany and Japan at the same time. So I guess we can't.
Right.
In World War II. That's not how it went. How it went was the Fed said, we're going to buy every 3-month treasury you offer at 3/8%. Every 10-year treasury you offer at 2.5%. Have a good day. Balance sheet went up 10x in 5 or 6 years. We put in price controls to make sure inflation didn't get too bad till after the war. And if you bought bonds, congratulations. Thank you for the war effort. You're a patriotic American. The S&P went up 5x relative to bonds during the war and shortly after the war. And by the way, you can't own gold. It's illegal. Have a good day. That's what's going to happen again in some way, shape, or form. Now, I don't know about... It's trickier. That's what's going to happen in some way, shape, or form. The bond market. It's trickier because of the system as it's structured. Open capital markets. There's no capital controls. There's no consumer price, consumer goods restrictions, right? You had coupons. You could only buy so much butter and milk and gasoline and what have you. So some form of severe repression, I think, is going to happen. And through that lens, the reason it's going to happen is because we're going to shift to a neutral reserve asset, or the reason it's going to need to happen is because we're going to shift to a neutral reserve asset, which will weaken the dollar, which will change the incentives enough so we're not offshoring anymore, we're reshoring.
Right.
Very inflationary. Also, you don't want to make gold or Bitcoin illegal because you don't want to impoverish your people, right? If you make gold and Bitcoin illegal and then you reshore and inflation goes through the moon, people are going to starve and revolt because the inflation is going to go nuts. You need something to go up to keep your people whole, not just stocks.
So I think I'm hearing, tell me if I'm hearing you. We have eviscerated our industrial base as a result of the fiat currency experiment.
Too much, yes.
And now there are national security administration layers that recognize that.
Yes, and they have for some time. This is a decade, at least a decade.
And they say, to hell with whatever centralized money monopoly wants to do. This is for shit got real, basically, right? Like we have to actually defend and produce and be able to fight and win wars again.
Yes.
So weakness maybe has been exposed through these recent conflicts, and now intelligence agencies inside of this country understand that and are looking to refortify the productive and even war-making capacity of this country.
I think there's a war-making capacity side to it too, and there's also people that understand that the fiat system has led to the worst wealth inequality in 150 years.
Right.
And regardless of which side you rooted for, everyone can agree that this country is getting politically unstable, which is what happens, of course, 100% of the time when you take out the middle class.
Of course.
And we take out the middle and working class, that's what happens. And how did you do that? You did that by separating and financializing, right? The energy from the money. So you've got to reconnect.
Are you telling me there might be some adults in charge?
Not in charge. But the adults in charge the people in charge some of them have adult
advisors
that understand this 100%. And so the game theory has changed around this for national political stability, for bringing back the middle and working class, for defense-based reestablishment. All of these things are pointing to a neutral reserve asset. Right. And then you go, okay, well, it's gold or it's Bitcoin.
Right.
And, Bitcoin, I think, has gone from eye roll, laugh in this sentence a year ago, maybe even 6 months ago, but certainly a year ago, 2 years ago, forward.
Oh, yeah.
There's still a lot of eye rolling around it, I think, especially among sort of the geopolitical pros. But I don't think there should be. Treasury is talking about how to use stable coins to create balance sheet, basically, for T-bills to finance deficits. Paul Ryan, former Speaker of the House, VP candidate, op-ed about how stable coins could be used to create demand for T-bills. Trump saying, Bitcoin is the new oil, reportedly. The strategic reserve, all of these things, you can see clear to the thought process, which is, in my opinion, simply a version of what the U.S. did in 73, right? In October 73 to April 74, oil went up 400% in 6 months. Sheikh Yamani of Saudi Arabia gave an interview in 2010 in which he said there was a Bilderberg Group meeting. Put our tinfoil hats back on. Bilderberg Group meeting in October 73 in Salzbaden, Sweden, that Henry Kissinger attended, and it was agreed that oil was going to go up 400%. You can find the interview online. He gave it to John Defterios at CNN International in 2010. Did Yamani. And what that oil price did by moving up that way was it effectively made oil big enough to back the dollar, to back the U.S. deficits, to recycle. Crazy. And so when I hear Trump, and it dawned on me recently, in light of the strategic reserve and Paul Ryan saying this, and the Treasury Borrowing Advisory Committee, do people understand who's on the TBAC? That is every too big to fail bank that would never want, they line up the biggest enemies of gold from 5 or 8 years ago, and they are the TBAC. Those are the American banks. And they wrote a supplemental report 2.5, 3 weeks ago talking about how can we use stable coins possibly to increase Treasury demand, T-bill demand. So there's something has changed in that sea change. And I think possibly what they might be looking at when you hear Trump say Bitcoin's a new oil is the Treasury TBAC report has a chart. Here's the market cap of, they use crypto. I prefer to only use Bitcoin. You get the point. Yeah. Here's the market cap of crypto. Here's the market cap of stable coins. Here's how many T-bills stable coins have bought. And it's linear. That's how they're looking at it. And so it makes me think, when you think about it that way, in the context of the political stability issues that that you need to address, the national defense issues you need to address, the game theory's turned on its head. Holy cow. Bitcoin isn't a threat that it's rising. It needs to go up faster. Wow. So that we have more balance sheet capacity, and so that our people, as we reinflate to reshore all this stuff, because it is going to be inflationary. Yeah. That's not a bad thing to compensate your people, to keep them whole on a real basis while that happens. Because look, if you make us all buy bonds, and this is how a lot of people are game theory, make everybody buy bonds, then surprise them with inflation when we reshore, then what? How can I afford to buy any of this stuff coming off the line? I'm broke. You stole all my money. Now do it with Bitcoin or with gold. Encourage the people. If I own Bitcoin, Bitcoin's going to go up with the inflation, with the money printing. Now we rebuild the factory. It's like Henry Ford paying his people enough to buy the cars coming off the line. It's this. And like I said, gold could do it too. There's a competitive element with gold, right? Where, hey, they did gold, we can do Bitcoin, we can one up them. There's elements of that. They could certainly do the same. But
to that point, right? If you're going to revitalize the industrial base of the United States, people have to have a sound savings. Otherwise, it's not going to work.
You're going to get done, and everyone's going to be broke, and all those businesses are going to go bankrupt. There's going to be no demand.
You'll be dealing with a social revolt and all the instability associated with lack of savings and impoverishment.
And this is what the bond market doesn't get yet. That's why I say it's going to happen again. I think the most variant view out there is the bond market is going to get killed on a real basis. You'll get every dime you're promised. But the only way this works, it's a debt restructuring. Go back to what we talked about, right? We spent $30 trillion. A lot of it should be zeroed out. We got no value out of it.
Which is the market working, right?
That's because the market working.
Aren't governments actually bankrupt? So shouldn't their debt get wiped out?
This is how you can restructure, like that's the only way that makes sense. You can't impoverish your people. Certainly not now after the last, with all this debt, you can't put all the debt on them, financially repress them. There's not going to be any demand when we bring all the stuff back. Then what?
So this is an existential issue for the country, basically.
Yes.
Like you can't impoverish people. You have to produce stuff. You have to be ready to defend.
It gets back to the initial point, which is inflate or default.
Yeah.
This is just the manifestation of like, let Bitcoin go, let gold go. The beautiful thing about it, unlike oil, right? You think about inflating oil 400%. People starved all around the world, right? That drove up food prices, coups, political instability, just inflation, awful. If the price of gold or Bitcoin, they're not used for anything. They aren't. They're useless.
That's right. Yeah, their money.
Beautiful. If the price of gold goes up 1,000%, 400% in 6 months, who starves? Nobody.
Right.
Nobody.
Right.
You're not impacting any industrial processes. No. You're not we saw 2011 with the Arab Spring.
It's actually the opposite.
No, exactly.
Yeah, less people starve when the purchasing power of money skyrockets.
Think about what the Chinese are doing versus what we're doing, right? Their home prices are going down, and people over here are like, "Oh, it's disaster," and it's not good for the banking system. Don't get me wrong.
Yeah.
But in a country with a closed capital account that's only open through gold, by the way, on a limited basis, but essentially a closed capital account, state-owned bank, state-owned property developer, who cares if the home price goes down? Like this guy's asset is they're two sides of the same balance sheet. Doesn't matter. But the point is this: when you store wealth in houses, sooner or later you run into a political problem. If you store wealth in non-useful stuff, gold, Bitcoin, people can afford houses, they can afford food, they don't riot. People with shelter and cheap housing and cheap food, cheap good food,
they don't riot.
They don't riot.
Yeah.
You're politically stable. And so the Chinese government's been, this is ironic as heck. Last 20 years, Chinese government's been encouraging, the communist country has been telling their people to buy gold. And our country's been telling our people not to buy gold by their actions up until recently. Gold goes up a bunch, great. Again, people, if it makes home prices go down, there's gonna be winners, losers. But ultimately, societally,
it's a win.
It's a win.
Yeah.
It's a stability. You're now playing for stability, for national survival. And that's ultimately that's the rule change that has happened that DOD and intelligence gets on at least a pretty good level. That Wall Street, I think, still the average investor, I don't think fully grasps yet. They're still in the, I want to flip it for a month and I've got to make my number, this year and all that. That game's over, I think.
Let's just assume that the argument you're laying out here is correct, right? The United States is doing this. The adults are advising the air quotes adults that are in charge, and we are actually going to do this, right? We're going to revitalize the U.S. industrial productive base. We're going to go onto I don't want to say gold or Bitcoin standard, but we're at least going to make it accessible to the middle class. We're going to rebuild the middle class and rebuild our productive capacity, and then rebuild our ability to defend ourselves as a nation. Let's say all that is true for argument's sake. What is the competitive response? What are other countries, if all this is happening, let's just assume this is all happening, what is China doing? What is Russia doing? What are our other peers at a national level doing in response to this change?
I think you can see what China's doing, right? Right now, they sell more to the Belt and Road than they do to US, EU, and Japan combined, right? So, as Larry Summers said, what they get from the Americans, what they get from the Japanese or the Chinese, is an airport, and what they get from the Americans is a lecture. And that was what an emerging market leader told Larry Summers either earlier this year or last year. So China is going to continue to reinvest sort of around the world. China has its own problem, which is demographic in nature. A lot of Asia has that same problem.
Right. Population is supposed to decline by like 50% over the next.
Yeah, it's incredible. And so what they have the same friction problem, which is you have to innovate fast enough to prevent the collapse of the system. And there's a lot to suggest when you look at David P. Goldman at the Asia Times is one of my favorite people to read. Anything he writes that I can see, I'll read. He's very balanced. And he highlighted the world is not paying attention to the pace and scale at which they are implementing and have implemented industrial robots, AI, et cetera, throughout the country. Automation. They are automating at a frantic pace. I had a friend tell me that, most of the major cities in China, you drive an electric car, you pull in, they lift the, like we do into oil change shops, except it's battery change shops. Boom, boom. They pull the battery out. They give you a new battery. You drive off. They take the battery. They recycle it.
Wow.
Yeah. So they are I think running headlong into automation, understanding they have that issue. They have a huge water issue too, which I think they also, it's a existential threat along with demographics. And so I think they've got a lot to do there. I think they also could probably continue to invest around the world. I think we probably continue to butt heads with them in current areas of critical raw materials. But, to the extent you're settling in a neutral reserve asset, it's about productivity. It's about competing. It's about, competing on the merits of your society and your leadership. Sometimes I feel better about that than others. What does Russia do? I think Russia wants to be left alone. I think they want to continue developing because, the thing we never see in our media is exactly what living standards have done in Russia since Putin's been president. Yeah. And it's up and to the right. People are like, oh, these, he has 80% approval ratings because it's all fraudulent. Well, some of it's probably fraudulent, but some of it's probably that the living standards have gone unbelievable since he's been president.
By embracing capitalism, right?
By and large.
Yeah.
Yeah. Certainly relative to what they were
the past.
doing.
Yeah, of course. Yeah.
I think they want to be left alone. They've built up sort of an autarkic society where they can pretty much stand alone. I think they want to, we just saw them hook up this giant gas pipeline to China that's been underway. Again, things aren't perfect between them and China, but there's a lot of land and not a lot of people and very mutual interest, particularly when you have one side, us, pressuring them both in an existential manner.
Right.
So it's possible, look, you back off the pressure. We start actually developing ourselves. The Chinese have their own issues to worry about. Russia has demographic issues of their own.
So more insular kind of defensive posturing.
I think more defensive posturing and I think decentralized, right?
Yeah.
Right. When you talk, I think where the world is going is multi-currency energy commodity pricing, net settled in gold, Bitcoin. Yeah. And in that world, currencies reorder on a balance of payments fundamentals. And unlike on relative interest rates, the US dollar is the dirtiest dirty shirt on a balance of payments fundamental. The UK's second. EU's right around neutral. The Chinese might actually be more now in terms of surplus, but the Japanese, Chinese, you would see the yen and yuan rise meaningfully, which, by the way, we've spent the last year and a half going over to China saying, stop sending us so much cheap stuff. The answer's simple. Let the dollar fall against the yuan. The stuff won't be so cheap. How do you do that? Neutral reserve asset. Markets will take care of the rest. So I'm optimistic that could lead to a system or a world where every country has their own sort of sovereign energy policy, right? Basically, how much, if oil is sort of I think that's a system where you would get, you'd have a neutral reserve asset where energy is deflationary over time in that neutral reserve asset. In other words, the price of energy goes down over time relative to that, which allows investment, allows sovereign choices around, what do we want for green policy, relative to our national oil endowment and what have you. So
lowers time preference across the board. And
Yeah, and war gets really expensive. Now, of course, everyone says, well, first thing you do is go off the gold standard, which, okay, yeah, the Bitcoin side's a little different, I suppose. It's harder to go off that once you're on that in theory.
Yeah, I wonder what the cost of defecting. I don't know. That's interesting to think about.
Yeah, I haven't thought a lot about the game theory of that on the other side, to be honest.
Yeah.
Jason Lowry's done a lot of interesting work in software.
I was going to ask you if you're subscribing to the software thesis, because we're definitely flirting with that.
Yeah. I mean, I think you'd be hard pressed when you have someone with his caliber, pedigree, seat, to think that this kind of thing isn't being talked about in high circles. And again, that book was published over 3 years ago, or his first sort of appearance on Twitter. Was his Jerry Maguire mission statement was posted over 3 years ago on Twitter. Then X now, and then he wrote the book a little after, right? So it's been being thought about for quite some time.
Yes,
these types of power dynamics. And you can get lost in the what's that world look like. But I think it's important not to lose the biggest thing, which is the whole, gold and Bitcoin aren't going to be allowed to thrive because they undermine the fiat system. Fiat system's dead. And I shouldn't be so flip.
Yeah. Death throes.
The fiat system has issues.
Yeah.
The bond, they won't let gold and Bitcoin go because the bond market is dead on a real basis. That's what I should say. On a real basis, it has to be.
Yeah.
And so if it is, and more importantly, if the bond market is the millstone preventing national competitiveness, political stability, and defense preparedness, who do you want to bet on? Right? You want to bet on the bond market being allowed to stay a market at the expense of political stability, national defense preparedness, and national unity? Well, come on.
Because then if you lose the latter,
there is no bond market.
Yeah. So,
and that's exactly what this is understood.
Yeah.
This is understood.
I'm glad you preempted me there by bringing up Lowry, because obviously a lot of the things we're talking about, again, is touching on the software thesis. It seems like, and I haven't talked to him since the Trump election victory, but it seems like we usually keep in touch every couple of months, that he is going to be in some advisory capacity to the White House about a lot of these topics. So, given everything we've talked about, if you were in that position, if you were sitting in that seat and you needed to be one of the adults in the room, how would you advise, let's just say American leadership, to keep it broad, as to what steps to take next to properly navigate this digital transition?
I think the most important thing is to get the order of operations right, which is to say, this is a debt restructuring at the end of the day. With 125% debt to GDP, 8% deficit of GDP at near full employment, foreigners having $13 trillion in dollar-denominated debt, but $22 trillion net in dollar assets, including $8.5 trillion in treasuries. If you cut spending really at all aggressively, you're going to send the dollar up, because you're going to push growth down, dollar emissions down globally, dollar's going to rise. Or if you put in aggressive tariffs, you're going to make the dollar rise mechanically. Same dynamic in terms of dollar flows. If you do anything that makes the dollar rise much more from here first, you will trigger the worst financial crisis in decades, if not since the Great Depression. Because what you will do is you will send the dollar up, and as the dollar goes up, yields will go up, and as yields go up, because yields are going to go up because foreigners are short dollars on their dollar borrowings, they're long dollar assets, they will send stocks down, they will send treasuries down. We will go right back to that 3Q23 setup of dollar up, rates up, stocks down, wash, rinse, repeat, until either They come in with a bunch of dollar liquidity, which is going to be very credibility harming. It's basically make themselves look stupid. You know, hey, we're going to cut a bunch of stuff. And then the market promptly crashes and the economy probably crashes and interest rates skyrocket. And then a month later, if they come back and go, well, we have to print money again, or we have to QE again to help the banks, you're done. Just go home, because now you're just like everybody else. You're all these other administrations. You're controlled by the banks. MAGA's dead. For whatever its merits, it's dead. So you have to get the order right. The only order that is right, that makes sense, you have to devalue the dollar first and big. And by that, I mean, you got to get debt to GDP from 125% today, probably closer to 70%, 80%, like instantly. You can do that a number of different ways. I've talked about it with like a gold revaluation. I've talked where it creates a cheap Treasury general account deposit that you can literally go buy the debt in the market and retire it without having an offsetting debt increase, and it would be very inflationary. You could have the Fed come out and just slash rates to zero, basically.
Right.
You could. I'm sure there's other things Treasury could do.
Isn't some of that debt owed directly to the Fed too? They could just extinguish
Some of it. Maybe they could. Yeah, I mean, the Fed's balance sheet's still what, 7 trillion something, right?
Yeah.
So some portion of that, you know, there's, maybe you could do something like that. Right, exactly. You restructure it. There's things you could do. But if you get the dollar down first, big, and get the debt to GDP down, like the debt to GDP is really the biggest thing. That gives you the flexibility to then say, you know, you just think about it conceptually. We're going to spend a bunch of money to reshore and retrain America's working class labor force and build submarines and all the stuff we need to do that we can't do now. And if debt to GDP is 125%, the bond market goes, and now you got to come in and cap it with yield curve control. And again, now you're that guy again, helping the banks. You've discredited yourself. You're better off just do it up front. And then the bond market will be like, oh, okay. I mean, the price wise, at least. I mean, you're still going to lose money on a real basis there. But by anesthetizing the bond market, it no longer has the vote and the power that it has. And to be clear, from our prior point, that power it has is now a threat to national security. Like China and Russia absolutely know they can weaponize that debt against us. You know, it's not just a competition of America versus China. The competition is when does the treasury market get dysfunctional, and does that happen faster than China? And what China has learned over the last 3 years is, we got a lot of issues, but the fuse on our issues is way longer than the fuse on the treasury market. By getting the debt to GDP down, you suddenly give right away, you give yourself massive more credibility when you sit down to negotiate these tough conversations around these trade deals. Because right now, China, you sit down with China, we want you to do this, this, and this. And China goes,
you got no leverage.
Piss off. You know what? Come back to me in 2 months when the 10-year is at 5 and rising every day. And now you come back and go, we can wait. You know, the 10-year is going to be fine no matter what. So why don't you, figure out what we're going to agree to.
Gaining leverage by reducing leverage, actually.
That's exactly it. I hadn't thought of it in those terms. That's exactly it.
That's so interesting. What? Okay. If we go down that path, wouldn't you want to, I guess, signal to American leadership that they would want to signal to the American population before they do this major dollar devaluation? Because it sounds like, to your earlier point about revitalizing, rebuilding the middle class, you would, I don't know how exactly it would go about this, but say, hey guys, we're about to devalue the shit out of the dollar, so you might as well put some purchasing power in gold and Bitcoin. You've been warned, right? PSA. Does that fit into what you're describing here?
In theory, yes. And as you say that, all I can hear is ETFs. Why all of it? Like I know of. I think there was an organic reason that happened. At least that's some of like what I've heard. There was an organic reason that some of the change of heart around it. But even then, if we were still in a world that a lot of people think we're in, which is nothing that is allowed to compete with the treasury bond and the dollar, should be elevated. Is it possible? I mean, to my eyes, why wasn't the ETF thing strangled in the crib no matter what? No. Gensler, no. Get whoever it is, no, they're not going to get approved. No. But it wasn't no. And not only was it not no, I mean, we're talking about very systemically important and easy for retail to access, most importantly.
So this is like that Bilderberg meeting you said where they wanted to let Black go. Okay.
Maybe.
Yeah.
Maybe. Who knows?
Yeah.
I don't know. Right. But like, look, if you don't own Bitcoin, like no one knew how to buy Bitcoin. Now you can buy it at Fidelity and BlackRock. And like, these are not, Coinbase, as big a company as it is still not known to probably 90% of Americans over age 50. Yeah. Maybe it's 50, whatever it is. And I'm not disparaging their brand recognition or anything. I'm just saying as an example. Yeah. But everybody's got, Fidelity, BlackRock, Van Eyck, whoever's, these household fund names. So I'm spitballing tinfoil hatting here a bit, but that's, it's not lost on me because I think it's a very valid question, right? Like, and the other thing too is there's something to be said for it's a little bit of a revolution, right? When you came into the Civil War, apparently 60% of the wealth in this country was held in the South. This is per Peter Turchin, his book End Times. And they wanted wide open free trade. You've got very low cost labor. And I don't, that sounds very flippant and offensive. I don't, factually, that's the case. They probably had amongst the they had very low cost labor and they were agrarian, right? So they competed with everybody very well and, they were selling agrarian products. And so they wanted wide open trade barriers. And in the meantime, the up and coming wealth was technology, rails, steel, shipping in the North. And they didn't want to compete with Britain and Germany and wanted trade protections. And so a little bit of it is, are we watching a shifting of sort of, you and I know who owns Bitcoin, the types of, they come from all kind of different walks of life, but I would say they're all creditors.
Yeah, for sure. Yeah.
They're sort of builders and creditors.
Nerdy entrepreneur types.
Entrepreneurial builders, creditors. Yeah. That's a good group of people that you want to like have a lot more purchasing power.
That's who you want allocating the capital.
So, I mean, look, I'm probably ascribing way too much forethought and motive, but just spitballing it. I think it's, to answer your question directly, the ETF thing and the implied retail expansion and reach, not only when, but the speed at which that happened. Yeah. I mean, I know they've been talking about it forever, but like when it was decided, I was taken a little bit back. I was like, wow, that really happened fast.
It flipped completely because it was stonewalled forever. And then
it was like, okay. I was like,
yeah.
So who knows? Like I said, I have some familiarity with it. I think in some cases it was a very organic decision. Yeah. But then again, I mean,
this is. I'm an optimistic guy, but a lot of these conversations on this particular topic tend to veer into the domain of the pessimism and the gloom and doom. This is an oddly optimistic vision of the future, I think.
I'm an optimistic guy. You could title this discussion. Luke's actually an optimistic guy. If I had a dime for every time I was accused of being some doom porn guy, I'd be retired already.
Not the conversation I expected to have at all, but actually really, it makes a lot of sense. Actually, I don't think it's naively optimistic by any stretch.
No, I think, and like I said, even 12 months ago, I think it would have been naively optimistic, particularly vis-a-vis Bitcoin.
Right. How fast things change, though.
It changed fast there. The other thing that really, I think, changed that we may find out about, we may not find out about, but NATO got crushed in Ukraine, including American strategies and American weaponry.
Right.
Yes, the Russians took a lot of losses, but we lost. And I think that may have been, when layered in with the financial and fiscal stuff we've talked about, I think that might have been it, of like, okay, like the time for slow rolling this reindustrialization, right? Because like Biden never repealed Trump's tariffs.
Right.
Right up until that election, the Biden-Harris administration was putting out a new reindustrialize America and build America's mineral reserves. Mm-hmm. Their constituency, if they would have seen that, would have lost their freaking minds. Again, I think it's the right thing to do, but I'm someone who, when I look at things, I look for not just what it's telling me, but I also look for the dog that doesn't bark. Mm-hmm. And you have that administration building up manufacturing and minerals, like, number one. But number two, he's senile and she can't operate without a teleprompter. So like, she didn't write the thing. She's not telling me we need to buy lithium and cobalt. Mm-hmm. Come on. So who's writing that?
Yeah.
One of the adults.
Right.
And one of the adults in a green administration, very far green,
right,
wants to get involved in a much bigger way in the dirtiest friggin' business there is. What are we supposed to think of that? Weeks before the election.
Yeah.
Like this was like, that thing gets out there, like their base could have been completely demotivated.
Yeah.
It's the right thing to do for America. But there's these kind of little signs all over. And I think ultimately it ties back to the Ukraine situation, which is we couldn't produce what we needed to produce. And I don't think this is particularly controversial to say at all. We couldn't produce when we needed to produce it. You can find it everywhere. You talk to anybody, unclassified stuff, like it didn't go well. And from the standpoint of like, we couldn't produce it fast enough. And in the meantime, David P. Goldman's saying he's hearing the Chinese can put out 5,000 cruise missile engines a week with their automated factories.
Wow.
We have like 5,000 cruise missiles total in inventory.
Fuck. Wow.
So if that's even halfway true, if that's 90% wrong,
it's still,
there's fires lit under asses across the Beltway. Like, and it's no longer, we need to protect the bond market. No one's going to give a shit about the bond market.
Shit got real. So is it then losses, right? Losses in Afghanistan, losses in Ukraine. We're going to see a pullback of imperialism and
I think on some level, I think that's like a realist. I mean, you're starting to see a little bit, right? When you listen to Elbridge Colby, who's I think acting in some sort of advisorial capacity to the Trump administration. It's realism. Yeah. This whole
realism. Yeah.
And realism is ultimately about reattaching the energy to the currency.
Exactly. Making the money real again.
We can't supply enough missiles to Ukraine without taking them from Israel.
Right.
And you want to talk about defending Taiwan? Like Hegseth gave an interview 2 weeks ago, maybe a month ago, something where it talked about like we run Pentagon war games, game after game after game. And one thing we all have in common in Taiwan, we always lose. We can't win there. Huh. It's the same problem that we have with Ukraine and Russia. It's in their backyard, right? Like they have sort of, operational dominance because it's in their backyard.
Yeah.
So we have needs. We aren't addressing the needs, and we've been going at it from like a fiat mindset, a financialized mindset of we'll just print more. You even see it this week with we're going to send all the money we have left to Ukraine that we can give them. We're going to give it to them. Why? It's over.
So it's the American empire has become overextended.
Yes.
That realization is dawning or has dawned.
It has dawned. I think it started dawning, 6 years ago. There was a report assessing America's defense industrial base. And, the unclassified version you can find online, it's 128 pages of like, holy crap, I can't believe we're this dangerously single or dual source to China on this much stuff.
Wow.
That was 6 years ago.
Wow.
And I'm told it's gotten orders of magnitude worse since in terms of the, oh my gosh, I can't believe we're this sole sourced, right? And you're seeing it now all over. Chinese sanctions a drone maker in the U.S. Can't make the drones without the Chinese batteries.
Wow.
Boeing, the machinists. We don't have these are all symptoms of the same problem, which is the fiat has gotten too far away from the energy, from the production.
Right.
And once you get too far away and you need to go in a hurry, you can go slow, but we don't have the time.
It takes a long time to turn the battleship around.
Right. And we don't have the time. So you're going to have to go fast.
Ooh, so this is a giant shift. I assume this shift would define many decades into the future. Like
I think so.
Once we go down this path, we're not going to change tact again anytime soon.
I think so.
Okay, that's all super fascinating. I guess the lingering concern I have in the back of my mind is globalism. Like, we still think in terms of, what is the United States doing versus Russia versus China? But then there's also this sort of globalist game being played, and nation states sometimes appear as puppets on strings to me. So I still have lingering concerns about that. I don't know if you have any thoughts on that, and then I'll ask you one more question and let you get out of here.
I don't have a strong feeling on it. The only thing I'll say is that in the shift of the world from the financialized to this political stability, national security, defense production base being dominant and necessary to rebuild. The goal in the financialized world was optimize for efficiency, which is to say, and that's a Lynn Alden phrase, minimum inventory, long supply chains.
Right. Just in time delivery and all that shit.
Everything we're talking about suggests that we're in pre-game warm-ups of going in the opposite direction, which is not to say everyone's going to stock a ton of inventory.
Right.
But even with the technology, look, if you can 3D print crap all over the place and AI can do it for you, why do you need a 6,000 mile long supply chain back to China?
Right.
You don't.
Right.
You can make it anywhere.
Yeah.
And then suddenly national jurisdictions start to matter again. And so I think we're going to see supply chains not go all the way back to hunker down autarky, but I think we're going to see a shift back in to supply chains for at least a nod to resilience, which then speaks to a move away from sort of the globalist, 6,000 mile supply chains of, parts from here or there and everywhere. It might be an optimistic view simply because China's so big, so good. They're unprecedented in terms of their share of manufacturing. People are it's just like Japan. It's nothing like Japan in terms of scale.
Right.
If you look back at the scale, I saw a chart from Bloomberg 2 weeks ago. Japan's share of global manufacturing at the peak in 85, when China was going to own America by 1990, it was 90 basis points, maybe 1.2%. China's 2 to 2.5% of global GDP, manufacturing. It's orders of magnitude bigger than ever. And critically, we had a lot of military bases in Japan, and we have exactly 0 military bases in China.
Wow.
Which nobody likes to talk about because it's not polite, but I'm from Cleveland. So
it is what it is.
It's a factor. It's a factor in negotiations, and you're naive if you think it's not.
Absolutely.
So anyway, it's not an answer, but I do think we'll see a shift back away from globalism towards more sort of robust supply chains and away from efficiency. But
yeah, I hope you're right. I mean, I do. I've long held out this hope that Bitcoin is a very American technology in terms of what it is, just really strong private property. I'm that's how and it's decentralized. Well, how did this country get started? Well, it was a fucking tax revolt. So it was giving people stronger private property and creating a decentralized governance structure, strong local, weak federal. And that's how we became so successful. Can't we just get back to that ethos?
It's so funny you say that, because I've said that to people before, where what do I need Bitcoin for? And it's not useful. Yes. And if you go sort of anywhere else in the world, say, hey, would you like a monetary asset that is safe from your government and that can't be inflated by your government, that your government can't grab and can't inflate?
Or any time in history.
Right? Yeah. And they're like, yeah, I'll take 2 of those, and 4 of them on Sunday, please.
Yeah, exactly. So I genuinely hope you're correct. I do have lingering concerns about the other dark forces in the world and whatnot.
So do I. This is shading towards the optimistic way this can go. I could paint you a one where you'd want to sort of commit Harry Carey by the end of it, but I don't.
Well, thank you for being nice today. I was in a good mood. So,
and I think it is. I really do think it's trending in this direction. That can change, right? Like that can change. I think we're in a very critical moment here. We're like lobbing missiles over at Russia, like it's like we're throwing snowballs. Before a new president.
Absolutely crazy.
But anyway,
I want to ask you one last question.
Sure.
So you're a father. How do you think about transferring this knowledge to the next generation in a way that sets them off in the right direction? It's not like we can tell, obviously, he who lives by the crystal ball is bound to eat glass. We can't tell them what's going to happen, right? We can equip them to deal with situations as they unfold. But I just wonder if you have any unique perspectives on your role as a father. I mean, obviously you're a great educator, but I'm sure, fatherhood takes it to the next level. Like, how do you think about conveying this type of material to the next generation?
Early, when they were young, all I did with this information was keep it from them to protect them. They don't need to know. And when I say young, 10, 12, 13, 14, let them be kids. 16, 16, they probably start talking about some of these types of issues. Once we started getting, and they learn the lessons of that, of like the key lessons of like hard work and do what you say you're going to do and those types of things. And that's what they need to know. The whole messy world, all monetary and this and that. And more recently, they're 23, 21, and 18 now, as we were talking about before. We jumped on the show. It's a very crazy world, right? Like the world that existed when my 23-year-old was born is gone. He was born before 9/11. That world is gone. And I think some version of that may come back again, right? That's the history is cyclical, but that's never coming back. And so what I think in terms of passing this knowledge on to them, I started off by, as it relates to sort of, I think you need to understand money as a person. And I don't think it's very well taught in our schools. I don't know if it's taught anywhere. I told them, look, rich people teach their kids about money and poor people don't. And that factors into why rich stay rich and the poor stay poor on some level. It's cliche and flip, but so it's about, I think, starting by teaching what money is. And when you then say, okay, well, what's money? Something we had them read was the first part of Safeteen's Bitcoin standard.
Oh, awesome.
They all read it. And, quite honestly, the first one, who's very cerebral, I was telling you before, I got him to start buying some Bitcoin, with his landscaping money earnings when he was 18. And to be honest, it's, very base. It started going up and he liked it. And he's like, oh, this is interesting. And then, one day it went down a bunch and he's like, this isn't fun. Why is this happening? And there's like nothing teaches like being, like that, like skin in the game. Yeah. And so, okay, read this. And then that led to a conversation about, okay, money and then energy. And it just having that skin in the game and having that interest, because you can lecture them and talk to them or whatever, but it goes right over their head. So the middle one, the ball player, was sort of like, And then he saw the older one. They talk all the time. My boys, thankfully, my wife did a wonderful job. They're very close. So they're talking. They're like, Dad, is it true that Gavin has this much? I'm like, yeah, it's true. How do I do it? All right, well, let's talk about it. You got to read this. And he understands the world differently. Gavin's very cerebral. Connor, not that he's not smart, he's also very smart, but he's a ball player, right? So he understands when you're seeing the ball well, you need to be swinging away. And when you don't see the ball well, you're grinding. And it's a constant game of adjustments. Right when you're feeling really good, that's, they're going to make an adjustment, then you make an adjustment. And that's sort of the economic, the rhythm of economic and
game theory.
Game theory.
Literally.
Exactly right. Hey, what's he going to throw me here? And, he knows I like this pitch. Is it, all this, right? So it's, so I realize I'm kind of rambling on. I think the way I did it was really getting that, interacting with them when they wanted to ask about it. Until they were a certain age, I never gave them too much about, the debt could do this or that or inflation. Like, they don't need to know. Like, let them be kids. And then just try to build, I think, getting just some skin in the game. And it can be Bitcoin, but I don't think it needs to be. I think it could be a gold coin. It could be, a stock portfolio on whatever, one of the apps,
Robinhood or whatever.
And just get them some skin in the game. Because I'll tell you, there's a reason why, if it isn't a pharmaceutical ad on our TV, it's a gambling ad. My boys tell me all their buddies are they're like addicts. Like, they're gambling all the time. I'm like, why do that when you can be learning and earning and, being just buy Bitcoin, and then you're watching or, get a Robinhood account. And then when you see things happen, let's talk. And I was so excited. My son, the oldest boy, got he had the Bitcoin. He's done well. But then he was talking about how, I think it was around Ukraine. And he's like, I think, this will probably be good for defense spending. And away from any political message of that, but that second derivative thinking around, is there a way for me to look to invest capital to participate in a trend that appears to be occurring? I was like, oh my God, it's happening.
It's working.
I felt like Ron Paul. It's happening. It's happening. The Ron Paul meme. So I don't know. It's not an answer. So I guess
that's a great answer.
It's protecting them young. It's skin in the game, getting some skin in the game, and then finding books that are not dense but very instructive. So
fundamentals.
I think I gave them for Christmas last year. I think I gave them Bitcoin Standard, and I think I gave them Kiyosaki's Rich Dad Poor Dad.
Okay,
because I think from a mindset standpoint, that is very good around what is productive debt and what is not productive debt, right? You run up, credit cards with a bunch of friggin' Zin packets. Congratulations. Let me tell you your future. You're not going to be driving the car you think you want to be driving. Versus, hey, this is a good investment. And even I think wisdom around, listen, education, don't think of your education as expenditures. It's an investment.
Yes.
Just make sure you focus on the right thing.
For sure.
Your food. Look, you can pay now or you can pay later. You choose your hard. Look, working out's hard. Being overweight and out of shape and having disease is hard. Pick your hard. So I send a lot of little sort of memes like that to them too, around just, I think things that are timeless and wise and around money as well as other things. So I don't know.
That's awesome.
It's a little bit of everything, but that's how and my wife's amazing, so that makes it easier. It's hard for me to screw it up because she's so good at what she does.
Well, like all great men, I'm sure you've got a great woman standing behind you or beside you, for that matter.
Rolling her eyes.
And I think that
rolling her eyes.
Well, that's what they do.
That's right.
They keep us in line. They put up with us. No, I think that's really good advice, right? To sort of give them the basics, the fundamentals, I guess, of how the world works, which, I don't want to be the hammer looking at everything like it's a nail, but money's pretty fucking important.
Money's just energy, right? Money is, and we say in our house all the time, money is just energy. It's money's energy. How are you deploying your energy, right? If you're deploying your energy into Zin packets, you're not going to have money. If you're deploying it into working hard and saving some and putting it into productive assets or assets that will prevent you from being inflated away, then you're probably going to end up with more money.
Exactly.
And like you are where you focus your energy, whether it's with your friends or with your money, whatever.
Yes. Where attention goes, energy flows. I've heard it put.
Yes.
So,
Yes. That's a good one. I like that one. I don't think I've heard that.
No, so that's really good stuff. And skin in the game. Can't overstate.
That's, I think, the biggest one.
Can't overstate that one, because, I mean, we all learn the hard way to some extent. I mean, some of us more than others. I think I had to run my head into every hard wall there was to learn anything. It is more cost effective to learn from the mistakes of others. However, easier said than done, basically.
It is easier said than done. Yeah. It is. And it's, and it's one of these things where when you learn, it's one of these things when your kids learning the lesson, let them learn it.
Yeah.
And it's, as a parent, it's the hardest thing. Particularly, you start getting into kids' sports even, right? They're going to lose. Let them lose. They're going to get cut. Let them get cut. Like, because the worst thing you can do is helicopter them and arrange it so that they keep winning and keep winning and keep winning. Because at some point, they're going to lose.
Yeah.
And like, you want them to lose and lose badly when they're young enough, when they're too stupid to not get crushed by it, right?
Yeah.
Number one. They're young enough and optimistic enough to not get crushed by it. But when you're there, when you're actually... when they're 12, 13, 14, these, and I'm not talking about like real loss. I'm talking about like, really losing, I don't know, the beauty pageant or the dance competition or the baseball game or whatever. Like really, like it was your fault. You screwed up, you bounced the pitch in and the winning run. Like, don't take it away.
Yeah.
You got cut. You weren't good enough. Well, you need to work harder.
Yeah.
Those guys worked harder than you. You got like, that, and that's the hardest part, but it's, I would say, especially as a father, maybe the most important part of just that sort of like the pat in the butt of, I believe in you, you and you got cut because you didn't work hard enough. They were better. How are you going to get better? I believe you. What can I do to help you get better? I will do anything.
Yeah.
If you want to get better, I'm here. Let's go.
Yeah.
Go feel this, go, take the pain and process it, and then let's get to work. Versus, it wasn't your fault. The catcher should have caught the ball, and let's go put you on this team where the guys aren't as good. Yeah, like it's not. You're not helping.
No.
In the long run,
they need the pain because that's where the wisdom comes from. The
wisdom and these. I mean, like I tell them all the time, like 90% of life is like showing up and sticking to it. Yeah, like, and. If you judged a fish by its ability to climb a tree, like every fish would be stupid. Yeah. So like there's so many different things there's so many ways to be smart. There's so many ways to succeed. Like my son plays college baseball and I tell him like you have no idea how easy real life is compared to college baseball. Like, like it wasn't like I would come home at night when, I had a bad day on the sales desk and, I come in the kitchen. Your mom wasn't like, you've had a bad week. I don't like the way you're swinging the bat, picking up the phone. So we're going to bench you in favor of this transfer from El Paso. Right? We got to transfer it. It's like the commercials are doing now, the backup dad, right? Yeah. Like I said, dude, there's 3 spots on the field, but there's infinite ways to be successful in life. Yeah. Like if you build the whatever you're doing, build the robustness of succeed, fail, work to that sort of very finite goal. Yeah. It does get easier. Just that it's a muscle. You can train a muscle of like, I failed and I'm not going to die. Yeah. Yeah. I'm going to be fine. In fact, I'm going to be better. In fact, fuck them. Cause you watch this, I'm going to show you. Yeah, for sure. Yeah. I think the reframe for me was it's not winning or losing if you're learning, right? It's winning or learning basically. Oh, it's and great. Then you're just always, whatever it is, failure, let's do it. Like that's what, through it. And I said, look, just don't make the same mistake twice. Yeah. Like, or if you make it twice, don't make it a third time for sure. Right? For sure. Like, a big one that I don't think a lot of people touch on around money for the boys and or for kids is, having the right spouse, partner, whatever that looks like for you, but also the money stories. right? Are your money stories the same? You know, if you have a spendthrift and a saver, that can be challenging. There, you know, and you don't have to be the exact same, but there has to be, those conversations should happen once the relationship gets to a point, you know. That's, I don't know.
No, that's great advice. That's great advice. You've been married a long time too, right?
Yeah, it was 25 years in June.
25 years.
25 years.
Congratulations.
Thank you. Yeah, she's not throwing me out yet. Yeah, so.
Luke, man, thank you for joining me. This has been fucking awesome. I knew it would be more optimistic than I thought, and it's great to meet you in person.
Likewise.
We'll have to do it again soon.
Yeah, I'd love to, especially in the wintertime. It's Miami's much nicer than Cleveland in November.
Well, now you've got an excuse to come down here and get out of Dodge for a minute.
Love it. That sounds great. Thanks for having me on. It was great talking with you.
Thanks, Luke. Thanks for watching. If you enjoyed this episode, click here to find more just like it, and here to find our most recent episode. Also, make sure to like this video to help shine light on the corruption of money, and be sure to subscribe to this channel to stay connected.